We've had an incredible run in a lot of these stocks.
Investors should be aware that things can change quickly.
If we have a change in narrative within the AI story, it can create exacerbated moves.
That frenzy is dying down around the AI trade in general.
There are going to be periods of digestion.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, stocks bouncing back. Equity futures pushing higher following a week full of tech losses as the White House and Iran are attempting to put an end to a series of strikes. Fed Chair Kevin Warsh is preparing for his debut outside of the US. Warsh, just a few days away.
Yeah, Chair Warsh is going to be presenting at the Sintra Forum in Portugal among a lot of ECB officials and other central bankers. And it comes as a key question faces the market. Is the market fading the idea of rate hikes as a result of what we've heard from Fed rhetoric, or despite it? Is this essentially rejecting some of the rhetoric that we've heard from the Fed meeting? Or is this essentially saying, well, if you're going to be more hawkish, we're going to price out less inflation and fewer hikes in the long term? Either way, is he going to lean into what the market seems to be saying, which is you guys aren't going to be nearly as hawkish as we thought you were when the Fed met last week?
We have got quite a week ahead for you, including Kevin Warsh, the Fed chair. We've got tons of economic data as well. Coming up on Thursday, not Friday, it's payrolls Thursday. The median estimate in our survey is 113K. That's down from 172 in a previous month.
Absolutely. This is going to be a key report, and we're going to get that report after we hear from Kevin Warsh. So potentially, given the fact that the Fed has been focusing, especially him, on stability when it comes to inflation, how important is that jobs report going to be? Also, we might get a Supreme Court decision this week, either today or later this week, when it comes to what is going on with the Lisa Cook case at the Supreme Court. Could be a little bit awkward for Kevin Warsh and Sintra.
Wide range of views over the Federal Reserve. Wide range of views on the Federal Reserve. Looking ahead to this from Kevin Warsh, Peter Schiff of Academy, with a different take on things. Take a listen to this. Imagine it's easy if you try. That Warsh convinced Trump that sounding dovish right now would be a disaster. Imagine again, it's easy if you try that he convinced the president to let me sound hawkish on inflation.
In other words, not buying it and not necessarily seeing them come through with it, which is essentially what the market seems to be suggesting at this moment. There is a sense that the president is giving him a reprieve. If he needs a whipping post, he goes to Jerome Powell, who is still on the Fed, although maybe after the Lisa Cook decision, maybe he will step down. That is some of the speculation. Nonetheless, a real question here, questioning the motivations. Right now, we're pricing in just a little more than one rate hike for the rest of the year. That's down from more than two last week. So you get a sense of how the disinflation narrative seems to be triumphing over the reinflationary narrative. The jobs number is really going to be key in that, in particular, just how much wages have increased.
On the margin, at least, with a move from 4.20 down to 4.1% on a two-year yield. Twos this morning, up a single basis point. Check out crude as well. Brent and WTI nudging higher by about 1.3% this morning on Brent. WTI back in the 70s, up by 1.7%. Attempting, and I stress attempting, to put an end to a series of strikes between the US and Iran.
Yeah, we saw an exchange of attacks happening in the Strait of Hormuz. Now you have both Tehran and Washington saying, basically, we have agreed to stop attacking each other, but you can see that Tehran at least was testing the ceasefire. And I think it's very interesting that there's supposed to be these expected talks in Doha this week, and an Iranian news agency just moments ago came out and said that they are not expecting or tracking any talks in Doha this week. So there's obviously a little bit of miscommunication, and the truce is holding, but again, ever so fragile.
Just about holding above 70 on WTI, $70.40. Coming up this hour, we'll catch up with Ajay, Rajadhyaksha of Barclays as equities looks to snap a 5-day losing streak. Norman Roule of CSIS as the tug of war over the Strait of Hormuz intensifies. And Momei of PSP Growth as South Korea announces plans for massive AI investments. We begin this hour with stocks pushing higher as the volatile tech trade finds a firmer footing. Ajay Rajadhyaksha of Barclays writing, there may come a point at which the AI infrastructure build-out overshoots demand. But that reckoning, if it comes, is a 2028 problem. Ajay joins us now for more. Ajay, welcome to the program. Why is that a problem for 28, not 27, not 26?
Just because, John, and good morning, thank you for having me. Just because order books, everything we look at for the Microns, the SK Hynix, the Samsungs of the world are still full well into late 2027. So the difference with the 2000 episode, if you remember, is that the Nortels and the Lucents of the world, their clients were startup telcos, which basically depended on financing conditions, being good to continue buying chips. This is not that case. In this particular case, the semiconductor chip companies, their clients are the hyperscalers, the single biggest profit-generating machine in history. So I do have clarity. I mean, you saw the Micron earnings. They continue to blow the cover of the ball. I think we do have clarity. As nervous as people are, and you get nervous at one point on the AI trade every single year, apparently. But as nervous as people are, for this year, for the middle of next year, I have a fair bit of clarity. So if you overshoot demand with a lot more supply, it will probably be a 28 issue.
It does feel like, though, Ajay, things are shifting. I'm hearing more about how expensive the build-out is and far less about a return on investment. Do you acknowledge that we are seeing a shift in the broader narrative here?
Absolutely. But I would push back on that being a lasting thing simply by pointing out that this happens every year. You seem to have a shift when the DeepSeek model was released, remember, and stocks reacted. Then in May of last year, there was another shift where the MIT use case paper came out, where you had the Nobel Prize winner for that year coming out and saying, I don't think there's a lot of AI use cases. And then you come into the early part of this year, where we suddenly all start worrying about SaaS, software as a service companies. And you can't have it both ways. You cannot make the argument that these companies should be taken to the woodshed because their business models are going to be completely upended by AI. And at the same time start to say, well, AI doesn't make a whole lot of sense. So I'm worried about the cost side. That is why I'm less unequivocally positive, but I still think the upside outweighs the downside.
Ajay, how concerned are you about a lot of U.S. companies shifting their use to Chinese open source models that are a lot cheaper, especially as the capacity just isn't there for the United States, let alone the cost that is really punitive?
I think from a macro standpoint, I'm not terribly concerned because I'm looking at the equity market and the economy holistically. So anything that drives down costs while continuing to increase usage, I would argue is not necessarily a net negative. But obviously, from a geopolitical standpoint, from a national standpoint, you are going to have concerns reflected in Washington, D.C. I don't know which way things go. I mean, you saw OpenAI start to drop its own prices, even as John pointed out, the cost of things is continuing to go up. There might come a question asked at some point whether we truly need 6, 7, 8 giant LLMs. It might be that the way that what is called the harnesses, the way that information is then fed back to you is what becomes the differentiating factor. But right now, I don't think that's not going to be the reason, Lisa, that you end up having the equity markets pull back 10, 15%, because look, a bunch of US companies are shifting to Chinese open source models. That's not a catalyst.
But it might reduce the valuations for the likes of OpenAI and even Anthropic, at least in the near term. It might question how much they can charge people. And we've seen that pushback from OpenAI and the IPO. And I just wonder how much that's a sign of what's to come, that the equity markets are sort of clamping down a little bit on their tolerance for some of these, pushing a lot of these companies just to rely much more on the debt market.
I would argue that it's a healthy thing. I want a fair amount of skepticism. I don't want everyone holding hands and singing Kumbaya and saying there's nothing to worry about, because that tends to keep, this effervescence in check. The fundamentals I don't think have shifted. You mentioned Anthropic, right? Remember, Salesforce was an absolute corporate darling. Went from 0 to 30 billion in annual recurring revenue, the fastest any company has been, and it took 20 years. Anthropic went from a standing start to 40 billion in ARR in 3.5 years. We take it for granted. But the pace at which the revenue side is growing in some cases is also extraordinary. And as long as that path continues, I think that outweighs everything else that is being thrown. This is the usual wall of worry that equities collectively are supposed to climb and what investors get paid for.
Ajay, when individuals come on the show, they say it's all about the earnings story. And you say that earnings story is no longer a tech story. Where are you seeing that broadening out for earnings?
Oh, honestly, everywhere. Healthcare, for example, is seeing a lot more operating leverage. Life sciences, you are starting to see earnings pick up more than expected. The industrial side is starting to pick things up. There are a couple of areas of disappointment. Financials have been a bit of a disappointment, not in terms of earnings, but in terms of the multiple side. But the biggest winner, the biggest surprise has not been... Big tech has done, I'm going to lay out a few numbers if I may. So earnings are up 19% in the first quarter. Big tech is up 30%. Well, big tech does big tech things, so that's not a surprise. But the rest of tech is the biggest surprise. earnings there are up over 50% year over year. And that, I think, is one of the things where things are starting to spread beyond just the hyperscalers, but also the rest of the economy. I mean, I don't want to do this, but honestly, I don't. But we had no choice but to up our earnings forecast for 2026. Yet again, it makes me more nervous. It's easier to stick with the crowd. We think earnings for 26 over 25 go up 21%.
Wow. Can that continue if the Federal Reserve is forced to hike interest rates?
Yes, it can. And part of the reason for that is because the part of the economy, part of the rate curve that matters to the economy and to the markets is actually the longer part of the curve. So you'll notice after last week's after last week's FOMC press conference, after the markets took it hawkishly, at that point, what ended up happening was that even as the front end sold off, priced in 30 to 40 basis points of hikes for this year, the back end actually rallied. And that's the point on the curve that matters. That's number one. Number two is, I would argue that with capex intentions being this forthright for this far into the future, and the wealth effects still being so strong, it's not clear to me that 25, 50 basis points here or there does anything to knock the US economy off course. So I think the story continues.
Ajay, it's funny, just to wrap it up, listening to you saying, I don't want to do this. I don't want to raise my outlook for earnings. With that in mind, where is the deeper pool of skepticism right now in conversations you're having? Is it on the bearish side or on the bullish side?
It is on the bearish side, unequivocally. And, we all have recency bias, John. So if you have a company that was valued at $100 billion a few years ago and it's suddenly a $1 trillion company, you just worry that it's got to come down to earth. The problem is that this company that I have in mind, these semiconductor chip companies, their forward earnings multiples are at 6 and 7. So they are reflecting that skepticism. They are reflecting that bearishness. There is not an equities multiple bubble right now. If there is a bubble, there is an earnings bubble. But for the foreseeable, that is why I don't want to raise my earnings forecast. But for the foreseeable future, I don't see that popping, even if there is one. And I'm not convinced that there is one.
Ajay, it's good to see you. Looking forward to seeing you back in the studio soon here in New York. Enjoy London. Ajay Rajadhyaksha there of Barclays. Not the only one constructive on this market. Just hearing from HSBC, Matt Kettner and the team. We remain undeterred in our pro-risk bullish stance. Lori Calvasina over at RBC overnight, raising her 12-month price target, Bramo, on the S&P 500. To 81.50.
Yeah, and it's all Ajay's point about earnings. We just also got from Jonathan Golub over at Seaport that the S&P earnings per share is expected to grow by 24% this year. That is versus a long-term trend of 0 to 8%. So they don't want to do it either. You can feel the reluctance. You can feel the sort of bear case is building. We heard that from JPMorgan last week. At the same time, the earnings tell the entire picture.
Equity futures this morning positive by 0.8% on the S&P 500. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The US and Iran agreeing to stop attacking each other before talks resume. Axios reporting talks are scheduled to resume tomorrow in Qatar. Tasnim, Iran's semi-official news organization, though, saying no technical talks are planned for this week. South Korea is arranging investments of at least $880 billion from companies including Samsung and SK Hynix into chips and data centers. The companies plan to build 2 chip-making plants each in the southwest to rapidly expand production capacity to meet increasing demand. Comcast shares rising in pre-market trading. The media giant planning to split its media and technology units into 2 independent, publicly traded companies, spinning off NBC Universal and Sky. Comcast is expecting the separation to be completed in about a year. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie a little bit later in the programme. Up next, a tenuous truce for Iran.
We hit them hard, and we're going to hit them again hard. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers.
You said that Iran violated the ceasefire. Will they face any consequences?
Well, you'll find out.
Up next, Norman Roule of CSIS, live from New York City this morning. Good morning. Days, no gains on the S&P 500, the longest run we've seen so far this year. In fact, going back to last summer, August 2025. Futures this morning bouncing back by, let's call it 0.7% on the S&P, on the Nasdaq up by 1 full percentage point. Last week, big outperformance on the Russell and on the equal weight S&P. Small caps this morning underperform, up by 0.15%. The bulls are not giving it up. We've seen a series of price target upgrades in the last week, including from Lori Calvasina of RBC just this morning, looking for something north of 8K now over the next 12 months.
And you are seeing the equal weight continue to lead that. What it shows you is that people are bullish despite themselves. They want to see the other side of it. And yet even Lori Calvasina, who's come on with us and expressed the skepticism time and time again, says that ultimately the earnings are broadening out, they're delivering, and that's the reason why we saw the equal weight hit a new all-time high last week and why you're seeing this broadening out.
That's the equity picture. Let's get to the bond market story. T's, 10s and 30s. We've talked lots about how this bond market appeared to be breaking away from the crude market, the oil story, reconnecting in some ways over the past few days. Up a single basis point this morning, two's at about 4.1%. Won't make too much of this, but crude bouncing back too, up by 1 percentage point, just around 70 on WTI. Brent crude around 72.50.
Yeah, and this is something actually that Neil Kashkari talked about as well. He doesn't have faith that this is completely resolved. Nonetheless, when you take a look at the Deutsche Bank mid-year survey, it seems like most people, 75% of those surveyed, see this as diminishing into the background in terms of the story. So if oil prices remain here, even though they're higher than where they were at the beginning of the year, people are saying this won't be as much of an inflationary force and won't push the hands of the people meeting in Sintra this week.
Let's talk about crude. Under surveillance this morning, a tenuous truce with Iran.
We hit them hard, and we're going to hit them again hard. We'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers.
You said that Iran violated the ceasefire. Will they face any consequences?
Well, you'll find out.
So here's the latest this morning. The US and Iran agreeing to stand down following multiple attacks over the weekend. The president warning Iran, quote, may no longer exist if Tehran continues to violate the already fragile ceasefire. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. Well, diplomacy appears to be back on the table, at least for now. A senior U.S. official tells us that there are planned technical talks that could happen as soon as tomorrow in Qatar, after we saw planned talks over the weekend completely stalled over this worst flare-up in fighting since the Memorandum of Understanding was signed. But breaking at the top of this program, we heard from Iranian state media disputing that there are any technical talks scheduled for this week and adding that they won't happen until the, quote, necessary conditions are met, without elaborating further, though we know all the focus right now is on the Strait of Hormuz, because this recent bout in tensions appeared to flare up as more vessels started to transit through using that U.S.-backed corridor that hugs the coast of Oman instead of taking that route that gets closer to Iran, appearing to threaten Iran's grip over the Strait. We heard the Iranian foreign minister over the weekend maintain that under the Memorandum of Understanding, Iran has the, quote, sole authority when it comes to reopening, but also managing the Strait moving forward, something that we know the U.S. disputes. Now, the flare-up did cause a drop in observed transit through the Strait this weekend, according to data analyzed by Bloomberg News, though traffic was still higher than for most of the U.S.-Iran war. Now, John, it's also probably worth pointing out here that amid this flare-up in tensions, we did see Iran target those countries in the region that are home to U.S. bases, including Kuwait and Bahrain, just as the U.S. Secretary of State Marco Rubio was wrapping up his tour to allies, trying to reassure them when it comes to the diplomatic progress.
Tyler, appreciate the update. More from Tyler in the next hour. Let's build on this. Roule of CSIS writing the following. The U.S. is defending the principle of free navigation and the international shipping of multiple countries. At some point, it may ask why it alone must bear this burden against a rogue nation. Norman joins us now for more. Norm, sir, welcome back to the programme. What gives you reason, if at all, to believe that we're close to that point?
Well, good morning. Well, we're probably not close to that point yet, but we are at some point likely to reach that. The events over the weekend were quite instructive. The ceasefire held, but it also showed us that the IRGC has a strategy to make the Straits commercially unworkable on a schedule of its choosing. The periodic attacks are not meant to be random provocation. They're a deliberate strategy to enforce Strait control and to restore premiums for insurance at a higher rate and to test our resolve on a schedule, again, of its choosing. At the same time, Tehran is unlikely to close the Strait because that would bring the world powers against it and deny it the benefits that it itself is receiving because of the end of the blockade and the oil that it is exporting on its own. So for the United States, we are in the position of having to defend Kuwait, Bahrain, international shipping. But again, we are doing this alone.
Norm, what is going to be the response politically to the IRGC still maintaining this control over the Strait of Hormuz, given the fact that the U.S. did lift sanctions on Iranian crude, as well as preparing some potentially unfreezing of funds?
Well, I'm not sure it's a political response. It's an international matter of international law. It's something we won't accept, or we haven't accepted to date. And the Secretary of State, in his meeting with the Gulf Cooperation Council prior to these attacks, issued a statement where all of the Gulf Cooperation Council, to include Oman, rejected Iran's assertions in this regard. Now, ironically, Iran calls for freedom of navigation in the Strait of Hormuz, but their interpretation of freedom is freedom under Iran's rules, regulations, and controls. So this now becomes an issue of sovereign rights as Iran is declaring this, which will make this very difficult to reverse. At the same time, there is a Lebanon connection to this. These events followed the conclusion of an agreement between Israel and Lebanon, in which Iran and the Lebanese Hezbollah were cut out. And it may be likely that the conditions to which Iran is referring are some greater involvement in the Lebanese issue. We saw Parliament Speaker Ghalibaf reach out to Nabi Berri in Lebanon over the weekend. It's probably that sort of involvement, that sort of engagement that Iran is seeking to demonstrate its regional role as well.
But Norm, does it not look like the U.S. tactically is accepting Iran testing the ceasefire, given the fact that they have lifted these economic pressures on the regime?
Well, the United States has indeed allowed Iran to export oil, has indeed issued a license allowing Iran to obtain funds from that. So that is correct in order to open the Strait as a whole. So you're correct in that regard. But the United States has also conducted multiple significant airstrikes on Iranian facilities over the weekend. Those were significant and quite damaging to Iran.
How can the U.S., Norm, justify removing all of the sanctions to some of its allies that have been pushing back about how quickly this is being done in light of the recent attacks, in light of the recent assertion of sovereignty over the Strait by Iran?
Well, that is going to be a question that will be increasingly asked of the Trump administration. The challenge for the administration is it must demonstrate that the memorandum of understanding is narrow, it is reversible, it is going to produce a consequential process, not necessarily a product, because again, we're seeking very large policy changes, significant policy changes from Iran on its nuclear program, its missiles, its militia program. These are issues that multiple administrations have sought for decades, but the process has got to show that it's doing something significant. If that doesn't happen, then we can't just be seen as providing liquidity to Iran and, in essence, funding the regime's programs that it will use to dominate the region itself. Recall that the money that it is obtaining from sanctions relief will go in some small but significant way to the Quds Force to maintain proxy relations in the Gulf, which will threaten Gulf actors and perhaps even Red Sea shipping.
Norm, always good to catch up and get your framework for thinking about things. Thank you, sir. Norman Roule there of CSIS. Crude's near a 4-month low. And as Norm pointed out quite a few times, he used this word process. This is going to be a messy process and not a clean one-off event, reopening the Strait. And it is a messy process, and we've seen that over the weekend.
Is this enough, though? This sort of uneven truce where they might be talking again, they might not be, they may agree to stop hitting each other. It's not going to go into a full-blown kind of kinetic conflict. Is that enough to keep prices where they are.
Brent crude 72, up by 0.6% this morning. Coming up next, we'll catch up with Momei of PSP Growth as South Korea looks to cement its lead in the AI race. Plus, Yahira has your morning movers. Comcast making a move this morning, up 24% in the pre-market. Equities doing better. We're higher by 0.8% on the S&P 500, up 1 percentage point and change on the Nasdaq 100, and another upgrade to a price target on Wall Street, this time from Lori Calvasina. RBC 8150 on the S&P over the next 12 months. As for year-end, price targets lifted at SocGen, JPMorgan, Barclays, Wells Fargo, all over the last 2 weeks alone. And if there is one common denominator here, connecting all of these calls, it always, nearly always, goes back to earnings.
Yeah, I think that Micron's 95% profit margin really solidified the feeling that some of these AI companies, you can sneer at them, you can say that they're not going to continue to carry their weight. Nonetheless, they are cash-generating machines, and we're reminded of that time and time again. The idea that we saw 26% EPS growth for the year that is forecast by Jonathan Golub over at Seaport gives you a sense of just how far above reality we are. Reality is 7 to 8%, 6 to 7 to 8% EPS growth in the year.
We have had truly a positive earnings shock in this country that has lifted this equity market almost across the board, particularly in the last week or so. Seeing the Russell start to outperform, seeing the equal weight start to outperform as well. We'll spend some time on that a little bit later. Let's turn to the bond market. 2s, 10s and 30s. Yield shaping up as follows. 2s around 4.1%, up a single basis point. We've got a week full of economic data. Payrolls on Thursday. We've got jobs tomorrow. The ADP and ISM on Wednesday. Chair Washington, Portugal on Wednesday. That one is noteworthy. Surely we're going to get the effort to really start to try and understand where the chairman stands on where the data is right now, and not tell us what they're going to do, but just give us an idea of what the reaction function might be in the months to come.
I'm just guessing that saying that there are 5 task forces isn't going to fly in Sintra, Portugal, with all of the other central bankers from around the world. Do we get a sense of how he's viewing AI as a disinflationary or an inflationary force, and exactly what that time frame is? Do we have a sense of how he would like to shift around some of the inflation metrics? The fact that we're going to be getting ISM manufacturing and the price is paid the same day that we have him speaking will actually be a really interesting 1-2 punch that could color the view of the bond market.
Don't talk if you haven't got something to say. Seems to be Kevin Walsh's mantra. He's talking, he must have something to say. We'll look for that Wednesday morning as we count you down to the up and about, 3 hours away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Comcast. Shares are absolutely ripping this morning, up nearly 28% in the pre-market after it announced just this hour that it is splitting into 2 publicly traded companies. Comcast will keep its wireless and broadband business, while NBC Universal and Sky will spin off into a standalone media company. The thinking here is that each company can focus on navigating their industries, which are vastly changing at the moment. Turning to SK Hynix and Samsung, they have huge news out this morning about huge AI spending plans, and that is helping to lift their suppliers after the companies announced that they are spending $880 billion to build out AI chip centers and data centers, and that is helping to lift equipment makers like Lam Research and Applied Materials this morning, which provide the tools that make those advanced chips. And we end on SpaceX. Those shares also edging higher in the pre-market, up 2.4% after NASDAQ said that the stock will join the NASDAQ 100 next week on July 7th before the market opens. That means index funds and ETFs that track the benchmark will have to buy billions of dollars worth of shares, creating a big source of demand. John?
Such a fast turnaround, that is. Such a fast turnaround. Yahira, thank you. More from Yahira in the next hour. On our radar this morning, one of our top stories, South Korea's top memory chip makers lining up massive investments in infrastructure. Samsung, SK Hynix, among the companies pledging nearly $900 billion on new chip-making plants and capacity. Elsewhere, Chinese AI systems reportedly matching Anthropic's powerful Mythos model as the capability gap between the two countries narrows. The Wall Street Journal reporting China's new model locates security bugs on par with US models, but still lags in other tasks. And finally, the Bank for International Settlements warning of global financial threats, including an AI investment bust. The bank's annual report highlighting vulnerabilities tied to circular financing and credit risk capable of triggering a major correction.
And this has only escalated because signs of rising leverage just seem to be percolating out of every corner, not only stocks on borrow, but also levered ETFs that have invested in some of these names. A concern here of how this could undermine financial stability heading into Sintra. I'm curious about another aspect of this as well. We're talking about valuations undermining some of the security. What happens if the security itself undermines some of the financial system? And this is something Christine Lagarde has talked about. What if a Mythos or Fable 5 can identify some of these potential flaws in systems, allowing hackers to get into, say, the payment system globally? I mean, these are the concerns that people have that could also be potential financial threats.
This is why originally you had the White House put a pause on Mythos. Fable is still on pause. Potentially they're going to lift that export control this week. Also, what the BIS talked about is policy actions. Policymakers need to step in to make sure that they make adjustments before it's too costly. You've talked a lot about if this White House was to say take an equity stake in an Anthropic or an OpenAI, it's because for those companies, do they want the U.S. government to be a part of their upside and growth or protect them from the downside? And when you start reading this BIS report, you think potentially these companies want the protection to the downside.
What's interesting, and one dimension that makes it a little bit more interesting for this week, it's not just the BIS that's saying this, it's Tiff Macklem of the Bank of Canada as well. And if you look at the panel that's coming up in Sintra, Portugal on Wednesday, it has Lagarde, it has Bailey, it has Walsh, and it also has Tiff Macklem at the Bank of Canada. So if you're moderating that panel and you're listening to this programme, there might be some questions to connect his views to what's happening here in the US and maybe try and tease out what Kevin Walsh has got to say about it.
Yeah, or elevated valuations potentially posing an increasing financial risk. And should that be something in the dashboard of the Federal Reserve they might have to deal with? We talked about that with Neil Kashkari actually on Friday, and he just said American dynamism is a great thing and we want to see that. And he didn't want to diminish that. I understand that from a PR standpoint. I do think, though, increasingly people are wondering whether monetary policy is, for all intents and purposes, easy, at least for some of the hyperscaler financing, and whether it is enabling some of these high valuations.
Look at how much money is sloshing around right now. Look to South Korea, upping its play in the AI race, announcing massive investments in chips and data centres. Momei Q of PSP Growth writing, on one hand, it signals demand is real enough to justify the scale of investment. The cautious read is that the cost of serving AI just keeps going up, and so does the burden of proof. Momei Q joins us now for more. Momei, welcome to the programme. There's two arguments there. Which one would you put more weight on at the moment?
Good morning. I think the overall sentiment in AI is still positive today. But the big question, the elephant in the room, is AI capex is not only just massive, but the estimates keep moving up, and we don't know when it's going to stop. First, the bottleneck is on GPUs, and now you see with the recent pair of investments that bottleneck has shifted to memory, and now we're talking about power. So the one thing that is certain is the expenses keep going up, but on the demand side, we are seeing optimism and we're seeing enterprise adoption starting to come in, but the timeline for that is still stretched out. So the question in everyone's mind is eventually, if this is critical infrastructure that is going to pay off, that everyone's going to adopt, then it's worth it. Otherwise, your capex keeps expanding upwards, and investors are going to be impatient.
Momei, have you noticed a shift in market sentiment over the past couple of weeks? Not the belief in AI and the promises, but the willingness to finance some of this, as evidenced by SpaceX's IPO, where the price did trade down and the bonds have lost value, as evidenced by OpenAI delaying their IPO potentially to mid-year next year.
Yeah, absolutely. I think the question for AI now has shifted from technology to financing, where the question of the day is not just on ROI, but let's assume demand does come, but who is going to finance it and for how long? And to your point, on the public market side, there was a time a few weeks back when we thought the public equity investors cannot wait to get their hands on the $4 trillion of new market cap across SpaceX, across Anthropic, across OpenAI. And although SpaceX, I think, is still trading above its IPO price, we're seeing that the demand is not bursting at all out of the seams in terms of everyone's just rushing to invest in that. And bondholders, I agree, bondholders are cautious that they're demanding higher prices. They're seeing on technology risk and years of negative cash flows that is uncommon in investment-grade bonds before. So I do think you have that caution, and it's fragile, right? You have OpenAI delaying IPO news, and all of a sudden you send shares of the whole AI trade down. And today, with the SK Hynix news and Samsung news, you think demand is back up again, and the finance markets are back up. So I think there's just a lot of fragileness in the market, but the overall sentiment, I think people are still pretty bullish.
As you do get some financing pushback, maybe there is still this bullishness underneath, but as you do get some financing pushback, how much does that advantage the Chinese AI players over, say, the U.S. ones? And I'm thinking of Anthropic and OpenAI, given the fact that some of those models are a lot cheaper. They are being adopted by U.S. companies that are constrained by both capacity and price here in the U.S. How much do you see this becoming a real trend and, frankly, the Chinese playbook?
I think the AI has already moved on from just technology to national security, national competitiveness. You see that with the SK Hynix news today, where Korea is starting to take its hold on the memory side, while the U.S. has Nvidia and the hyperscalers. And I do think China has a lead today around the open source models, around offering the ability to run AI models more cheaply. So I think that is still shifting, and the story is still being written out right now. But every country, because now it's not just about technology, it's about national competitiveness, is trying to find its own edge in terms of where it can have a hold in the market in terms of its advantage and competitiveness.
Speaking of China, there was a report over the weekend Apple is pressing the White House for approval to get chips from a Chinese company that is actually blacklisted. Do you see potentially more pressure in the policy arena because of what is going on with the chip sector, the demand issue, but at the same time, to Lisa's point, the cybersecurity and national security issues at play?
Yeah, I think those are all intertwined. Again, the AI has shifted now from technology to a national issue, and I think you will see this tug of war between the economic side of things and the national security side. I mean, a few weeks ago, we saw this conversation happening with Nvidia, right? Should Nvidia even be supplying GPUs at all to China? And I don't think we have an answer today, but I think that's going to be part of the conversation for the next few weeks and months to come.
There was another report about Google putting limits on Meta's use of Gemini AI models. Everyone is just trying to get compute. There's just not enough demand. At some point, when do you see this leveling out?
Well, we are building out the groundwork, right, of AI infrastructure. So I think the things that everyone's paying attention to is AI now going to become something durable? And I think you won't get to see that until the costs are really coming down. There's a lot of focus on costs in inference right now, and you have to believe that the enterprise adoption is going to come, and that is still waiting to be proven out.
Momei, it's always good to catch up. Looking forward to seeing you in the studio next time. Momei Q there of PSP Growth on this situation. This situation is getting a little bit messier. We need to build out capacity. That much is clear. We're capacity constrained across a number of dimensions, and we've heard that repeatedly on this program, but it's getting more expensive to build out that capacity. And you're not seeing a commensurate increase in pricing power at Anthropic or OpenAI based on anecdotal evidence of the last few months. So that's going to be difficult to resolve that tension.
Yeah, they can't necessarily make up for lost revenue from lower pricing or not increases quickly enough by simply increasing capacity, because the capacity isn't available, to your point. And so you start to wonder, do they start losing market share to some of the Chinese competitors? Do they start just lowering their valuations with their profit margins starting to come down? Or is there still enough critical mass for them to keep charging what they're charging? And are they advancing more quickly to be able to charge for the most extreme and frontier models?
We've done this a few times. It's happening again. The narrative is slowly shifting around this story. Equity futures this morning up by 0.8% on the S&P 500. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Andy Burnham making his first speech since confirming his intention to succeed Keir Starmer as UK Prime Minister. Burnham expected to announce plans to hand more decision-making powers to local authorities, overhaul procurement and tackle youth unemployment. Apple is pressing the White House for approval to purchase memory chips from blacklisted Chinese company CXMT. The Financial Times reporting Apple is seeking guarantees that the company will not be added to the US entity list, which would impose stiff licensing restrictions. In sports, England securing the top spot in their group at the World Cup after scoring 2 long-awaited goals against Panama. Lionel Messi scoring yet again for Argentina, who remain unbeaten so far. And Canada eliminating South Africa as the knockout stage gets underway, scoring the winning goal in stoppage time to break the draw. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next on the programme, penciling in a rate hike.
In March, I had penciled in 1 rate cut by the end of the year. In June, I've changed that to 1 rate hike by the end of the year. It's a pencil, and so we're going to have to see how the data comes in.
Aditya Bhave of Bank of America is penciling in 3 this year. He joins us next. Days, no gains, Monday through Friday last week. Let's see if we change that this Monday morning on a holiday-shortened trading week. Equity futures positive by 0.8% on the S&P. On the Nasdaq 100, we're higher by 1.2%. In the bond market, looking ahead to a week full of economic data. Payrolls Thursday. I mentioned that a few times. Payrolls Thursday. We are closed on Friday, of course, to celebrate the birthday of this great country. 2-year yields right now, 4.1%. Yields higher by a single basis point. Under surveillance this morning, penciling in a rate hike.
It is our job to get inflation back down to 2%. It's been made much more challenging because there have been all of these, what we call supply shocks hitting the economy. In March, I had penciled in 1 rate cut by the end of the year. In June, I've changed that to 1 rate hike by the end of the year. It's a pencil, and so we're going to have to see how the data comes in.
So here's the latest this morning. Minneapolis Fed President Neil Kashkari signaling a potential rate hike this year as the central bank braces for a busy week of data. Aditya Bhave of Bank of America expecting 3 rate hikes in 26, writing, a July move is in play, though we think the Fed will want to see the summer labour data before hiking. Aditya joins us now for more. Aditya, good morning.
Good morning. Thanks for having me.
Are those 3 hikes in pencil for you and the team?
They're in pencil. For sure. Yeah, okay. we don't know what Kevin Warsh is really thinking. He likes to keep his cards close to his chest, so we'll see how it plays out. But from our perspective, it's a pretty simple exercise. It's the data, it's the reaction function. Where's the unemployment rate relative to a year ago? It's unchanged. Where's core PCE inflation relative to a year ago? It's 60 basis points higher. And yet, the policy rate is 75 basis points lower. Even if some of that inflation pickup is because of one-offs, I think they're clearly offside. You don't need replay to see that. There's a problem here. So why not just take back the 75 basis points of rate hikes? Then you talk about the reaction function. We thought going into the June FOMC that this was a committee that was fundamentally dovish. They would find reasons to not hike rates. But then look at the SEP. It's not just that 9 folks are expecting hikes this year. It's that no one has the unemployment rate coming down in the full range of forecasts. So labor tightening is not a prerequisite for rate hikes, as we thought it might be. And then finally, Warsh, he did not take the opportunities he had, in our view, to be dovish, to push back against the case for rate hikes. They didn't talk about wage inflation, inflation expectations. So we put all that information together, and we're thinking, actually, if he wants to hike, this is his best chance. It's not his fault. He can blame it on the previous regime, and he can take the credit if there's disinflation down the line.
2 pillars for this, the data and the reaction function.
Yep.
Is it harder at the moment to understand one versus the other?
Well, the data is pretty clear from our perspective, and the data has been moving in that direction for a while. There's open questions around the reaction function, and folks have legitimate disagreements with us about that.
Part of the reason why people are disagreeing is because there's speculation that hawkish job owning is doing enough of the heavy lifting.
Yep.
And we've seen actually a disinflationary bet kind of percolate into the market over the past couple of trading days, or just really on Friday. And how much do you view this as a market saying that they don't believe that this Fed truly is hawkish?
Well, hawkish job owning works to a degree, but ultimately, if it's just job owning, the veil will come off, and then markets will reprice that inflationary impulse, right? If they don't ultimately follow through and hike rates, either that or they're going to have to get lucky on the inflation data.
Are you expecting wage inflation to start picking up? Because that's a key ingredient for this Fed to not just see a lot of the inflation data of late as backward-looking and tied to what we've seen with Iran and the U.S.
Well, wages are the most backward-looking. That's the thing. Wage inflation lags price inflation, and price inflation itself is backward-looking relative to the other economic data. So I think they would be making a mistake if they were to wait for wage inflation to pick up. First, the labor market tightens, then wages pick up. So we're not expecting wage inflation to necessarily pick up in the next couple of months, but the risk here is the labor market starts tightening, and then they're way behind the curve.
What's forward-looking?
What's forward-looking? I think activity is relatively coincident, right? So labor data is more coincident. I mean, nothing can be forward-looking almost except sentiment, but sentiment has not been a good indicator of economic activity of late. So you can look at spending, for example. I'm going to plug our own data here. We have data almost in real time on credit and debit card spending by Bank of America customers, and that looks really good the last few weeks. We have data through the middle of June, and as gas prices come down, spending on other components has actually gone up, even though when gas prices went up, spending on other components didn't necessarily weaken.
Aditya, what are you expecting on Thursday when it comes to payrolls?
We're looking for a solid report, 120,000 private, 110,000 total. So another good month of non-farm payroll growth above where we think break even is, which is why, going back to the conversation around the unemployment rate and wage inflation, the risk here is we can't keep printing these payroll numbers without the unemployment rate coming down. And if that starts coming down, then both your mandates are pointing in the same direction. So we think, even if you look at the data now, labor's balanced, inflation's showing upside risks. All you need to do is take back the hikes that you did last year. You were buying insurance against an event that didn't really play out.
Is Kevin Warsh's European excursion this week important for you?
I don't have a strong view on what he's going to say in Europe. It's a bit too early to talk about the task forces. It feels like
well, hopefully you get some names. Who's running
yet.
These things?
Right. So I don't think he's going to announce that at Sintra, but probably the message at Sintra will be quite similar to what we heard in June.
Do you see the task forces as an exercise to delay or to get things done?
It's possible. It's a theory that we've heard. The question is, can they hold off? I mean, he said that you're not going to get recommendations from the task forces until December, and then it'll be up to the FOMC as to whether it wants to take those recommendations. So can they hold off until December? And if there's an indication that they are holding off until December, then we'll have to rethink our views.
You're certainly holding off until after the summer, right?
We are, for now. But as we said, July, I think, is live.
At this point going forward, what would potentially make you rethink any rate hikes at all?
So a few things. The first one would be if the labor data over the summer are weak and the unemployment rate starts going up. Second, inflation. So if you get weak, not headline, we know headline's going to be negative in June. We knew that the oil path was going to cause headline to be up and then back down. Core. If core inflation is weak to the extent that the year-over-year rate starts coming down, that's something to look at. And then third, if you do get a big correction in the labor markets, it would have to be big to the extent that the Fed is worried about financial conditions. Right now, they're worried in the other direction that financial conditions are too easy, and I think they're right.
Aditya, it's good to see you. It's always good to catch up. Aditya Bhave there of Bank of America, looking for 3 hikes in pencil later this year. Got quite a big week coming up. We've got jobs coming up tomorrow, week full of economic data on the job side of things. ADP coming up on Wednesday, payrolls on Thursday. The Fed Chair Kevin Warsh in Sintra, Portugal, this coming Wednesday morning.
Yeah, and AMH asked, how much do you care about it? I care a lot about his trip to Sintra, Portugal, because it is a destination known for its mystical, mist-shrouded hills, whimsical castles, and lush, exotic gardens. And it looks like it is straight out of a fairy tale. So for all of those in Sintra, Portugal, enjoy. It looks like a truly beautiful...
Are you doing a TK? Going onto the Wikipedia of Sintra?
I actually was going to Gemini. You know, I've upgraded.
Oh, right. OK.
It's not a bad first trip as Fed chair, is it?
Yeah, I was about to say, I care a lot about it. No, look, I think it's going to be really interesting to hear what he says. I always just find the backdrops for these.
Are you messaging management to see if you can go on that junket as well?
I haven't gone full tour
yes, okay.
for that junket as well.
That's where this is going.
You've got a list of my junkets?
That's where this is going. Coming up next, Alicia Levine of BNY Wealth, Noor Cristiana of JPMorgan Private Bank, Steve Englander of Standard Chartered, and a whole lot more from New York City this morning. Good morning. The second hour of Bloomberg Surveillance up next.
There are pockets of stress in the economy.
Inflation expectations have probably got a little bit ahead of itself.
Inflationary pressure is going to subside.
The Fed is going to be very cautious about tightening in this environment.
The Fed should be able to walk and chew gum at the same time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action, look like this. Equity futures session highs up by 0.9% on the S&P 500 after going 5 days without gains on the benchmark stateside. In the bond market, yields shaping up as follows, just about unchanged on the session so far at 4.1%. Heading into this week right here, a week full of economic data and an address we will hear from Kevin Walsh, the Fed chair, in Sintra, Portugal.
Yeah, how much will he really lean into some sort of reaction function that's similar to what the market interpreted a week and a half ago, which was that they are going to be more hawkish, they are going to potentially raise rates, or how much will he lean into the disinflation that's getting priced into the market? One kind of comforting feature of the rally that we're seeing this morning is that there seems to be at least some release valves in the Iran-U.S. tension, so it doesn't seem like we're going to get oil prices once again threatening the narrative. Also, you have this sort of domestic push to try to invest in technology that you're seeing from South Korea. You put these two things together, it's the bomb to really make everyone feel a whole lot better.
I think everyone's hoping to get a little bit more understanding of Kevin Walsh and how he's thinking about things as he takes on this new role. But Aditya Bhave was saying he's not really expecting anything out of this Sintra speech. I'm actually also interested, besides the fact we have the Supreme Court decision potentially on Lisa Cook, that can come today or later in the week, maybe when Kevin Walsh is set to speak. But also, how is he received? Remember, last year at Sintra, Jay Powell got this standing ovation, and everyone was clapping for him and lots of chatter about how he was standing up to the Trump administration. Well, this is Trump's pick, and it'll be interesting to think how he is with his colleagues and the other central bankers.
Mark Carney endorsed this guy. There's a number of establishment figures
but I still
that got
think it'll
behind
be
Kevin
interesting.
Walsh. It's not something I'm looking for. I've heard that view a few times. I don't think it's particularly out there. I just kind of disagree with it. He was endorsed by so many establishment figures over the last few months. He's worked at the Federal Reserve, the institution. It would be highly controversial if they did give him the cold shoulder at an event like this one.
What officials that have spoken from the Fed have said so far is that they actually feel like it was really collegial and good. And so far, he has had a similar tone. And honestly, he served at the Fed as a governor from 2006 to 2011. This is not somebody who is new to the institution. At the same time, it'll be interesting. Do people lean into the task forces? Is Christine Lagarde going to have a task force? Brooch or scarf?
This market rallied through a war, rallied through an inflation spike, rallied through an increase in rate hike bets of the Federal Reserve. It rallied through all of that because earnings are so good right now. We have experienced a positive earnings shock in this country that was widely unexpected coming into the year. Look at the price targets we've seen in just the last week from SocGen, JPMorgan, Barclays, Wells Fargo the week previous, and Lori Cavacino of RBC already this morning.
Yeah, although something that Ajay Rajadhyaksha said I thought was really interesting. Earnings bubble, right? Are we seeing the peak in terms of earnings growth, particularly when it comes to the memory chips? We see the Korean memory manufacturers trying to build out more capacity. With respect to OpenAI and Anthropic, are we seeing the peak in how much they can charge in contrast to, say, the cheaper Chinese models? I mean, these are some interesting questions. Not to say that it's going to cause some sort of huge crash. Just these are the questions that people are speculating on when it comes to some of the rounds of fundraising.
What was so interesting about Ajay was the tone and tenor of his comments. I'm not surprised he's saying he needs to upgrade earnings. Remember the height of the war, he upgraded his S&P 500 target. But he says he doesn't want to do this. It felt like he was a little bit uncomfortable leaning into the fact that he has to upgrade earnings.
I asked him, where's the deeper pool of skepticism right now, on the bearish side or the bull side? And he said the bearish side. It tells you something. There's some information in that, some reluctance to really upgrade his outlook for earnings.
Try betting against this freight train. If you have, you've had your face ripped off. And that's what a lot of people in the market have watched. And they said, look, we can't fight against something that's real and that's coming and that, frankly, is getting adopted broadly across all of business.
You might have heard a few weeks ago, even Lisa's bullish now.
Okay, well, on the technology, I'm not, okay, all right. But I'm not going to clarify. Don't need to know. I think that you can be bullish on the technology.
Bullish Lisa's fun.
I think it's interesting.
That sounds like a climb down.
It's not
bullish
a climb
on the
down.
tech and not the market.
I'm not looking at market valuations at any particular time, but you can't reject what's currently going on. You just can't. I mean, I spent the whole weekend trying to figure out how to code different agents for myself. It's quite impressive.
All right.
They're interviewing me.
You're the reason why we don't have compute.
Sounds like a climb down.
Yeah.
Just on the margin. I'm bullish the tech, not the market.
I don't make a call.
Okay.
I'm observing.
It's fair. I don't make one either. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth with stocks aiming to get back on track. No Cristiana of JPMorgan on the first true test for USMCA. Steve Englander of Stanchart rolling out hikes for the remainder of the year. We begin this hour with stocks looking to bounce back from a week full of tech jitters. Alicia Levine of BNY Wealth writing, expect a summer of volatility, a midterm election year, AI backlash and IPO supply will produce a consolidating market. Alicia joins us now for more. Alicia, good morning.
Good morning.
Given all of those things, that long list, what's the road, the path to 8K?
So the path to 8K is the earnings, right? It's the earnings and the fact that it's not just focused on the AI beneficiaries, but it's actually broadening throughout the S&P. And that's what gets you to the 8,000. Also, the multiples are really not that high. We're back to 21 times forward earnings in a market that's growing at 23 or 24 times on the earnings side. It's pretty extraordinary. And we're still looking for 17% growth for next year. So you're following two very strong years with a multiple that seems fine, but you're going to get volatility. There has to be consolidation here. I mean, some of those charts are parabolic with the memory names, that's the center of that. And it's going to pull some of the market down with it just because they are the leaders right now, right? It's not the Mag 7, the Lag 7, right? Maybe there's a buying opportunity there, frankly. But that's what's led the market higher. So you've got to, so it's not just tech, it's not just memory, it's all over the industrial space. Healthcare is raising its head here as an interesting sector to look at. The charts look a lot better. But those are not large enough to get your index higher. So, you're going to have a rotation, but you're challenged probably on the index level for the next few months.
Outperformance on the equal weight, outperformance on small caps.
Right.
You alluded to it. Is it time to start thinking about the hyperscalers again, which have really lagged the likes of Microsoft
and they look terrible on the charts. But I think that you have to believe that the managements there are not going to let their businesses go quietly into that dark night, right? I mean, if you think about some of the other companies in the hyperscaler world where we thought that was the end of it, it's never going to happen, and then they revamped their businesses, and we have to believe that the managements there are going to do that. The headlines don't look great, charts look terrible, but given the massive outperformance on the hardware side, I think there's some room here for the hyperscalers. I mean, what's happened is the $800 billion that 5 companies are spending is funding the EPS of of 60 companies. So that's where the investor base has gone, pulling capital from the spenders into the recipients. And so the question you have to ask is, one, how long can this funding go on? And two, what's the reversion trade?
Are you expecting them to cut back on CapEx and actually push back on the pricing from some of these chip manufacturers?
So the market is telling them to do that. The market is saying you're not going to get the multiple if you keep on spending like this. Yet at the same time, the AI beneficiaries still move higher. So there's a bit of a schizophrenia here about what actually is the path to, sort of a peaceful place for the market. At some point, you're not growing CapEx 100% year over year, right? The growth rate is going to slow. Still positive, but a negative rate of change. That's where you're going to get the negative impact on the AI beneficiaries. And that's where you're going to start to get some movement out of the hyperscalers.
Where is the pushback the greatest when it comes to the financing of this? Is it just in the share price of the hyperscalers, or is it actually in the recent performance of the SpaceX debt and equity, as well as the potential delayed OpenAI IPO?
So I think it's really in the hyperscalers, because the question fundamentally is, can the spending justify the businesses that are going to come out of this in the next 3 to 4 years? And so that's really, you're seeing it in the equity market. And don't forget, the business models have changed. We used to talk about the hyperscalers as bond equivalents, right? Throwing off cash, stable businesses, very high margins, high free cash flow margins. We don't have that so much anymore, right? So you've got, 2 or 3 of them, actually selling debt, having to sell debt, not just equity, but debt. That's a very different business model. And that's what's happening on the equity price. It's just reflecting a different business model.
Well, to that point, BIS, and we talked about this in the last hour, the Bank of International Settlements is warning against these threats of this circular financing. It's not just equity, it's debt when it comes to the AI build-out. Does that give you caution?
What gives me caution is that I see correlations everywhere, right? So there's something of a concentrated correlation. Now, I'm a bull. We have an 8,000 price target on the S&P. But we have to be cognizant of the risks. And the risks are that you have more or less 20% of the S&P driving the earnings of the rest of the market, funded by 6 companies of the S&P.
And you have a bond market, which is now reflecting AI as well, because the hyperscalers are funding themselves with debt to do this. Then if you think of emerging markets, think of the indices, right? South Korea, Taiwan, well, 50% of the EM index is now AI as well. And so when you put it all together in what we do, a diversified portfolio, you're starting to look at concentrated risk in AI across all your asset classes. And so as an asset allocator, that's what you really have to be focused on. Like, how do you hedge that risk?
How do you?
Okay, so we think, for infrastructure and real assets are a must in a higher inflationary world. It's not popular to say goodbye Europe, but Europe really is not the AI play, and other developed markets that are not, focused on AI. So you have to really think about, how does your EM exposure pair with your U.S. exposure if it's all being driven by the same factor, which is AI investment and AI, beneficiary. I mean, that's the issue. That's the big issue for all of us who do asset allocation and think about building out portfolios that can withstand this.
It's a crazy distinction. Over the weekend, just going through the numbers, the amount of money being spent on capex in this country from a handful of companies on AI. Then you look to South Korea in the headlines from Samsung and SK Hynix, looking at $800 billion, something like that, in investment over the next however many years. And then, I don't mean to be flippant about this, you've got Europe arguing about aircon over the weekend.
Right.
That's the situation we're in right now. That's the great divide.
Maybe that's your diversifier. If you want to get away from AI,
it's kind of shocking.
It is shocking. And there has been a huge push to say, what is your AI story? If you take a look at the top big 15 AI providers, there is only one, Mistral, from Europe, and it is down really low. It is like in the 13, 14, 15 position. And you have U.S. and Chinese companies taking the lead. This is increasingly a domestic competition types of story. You're seeing that sovereign story come from South Korea in bold relief this morning.
Just piling into energy-hungry technology in China, Europe, South Korea and elsewhere, and Europe is just somewhere else. Just somewhere else.
They've got good food, and I hear that.
Fantastic food.
Yeah,
I love Europe. You know
honestly,
that.
Yeah, but I think
the policy debate is just like on another planet right now.
Right now, it's been taken to space by SpaceX, maybe, to Mars.
European soccer fans, though, or football fans in America, are discovering air condition, and they think it's like the greatest invention ever.
They're discovering abundance. They're discovering abundance across a number of dimensions. That's the major difference of the experience in America versus Europe right now.
There was a great story about Dutch tourists going to the suburbs in places near Kansas City and experiencing a Costco, experiencing a Walmart, experiencing a strip mall, experiencing the gas stations. They were impressed by the wealth, the abundance. They were not impressed by the abundance of food or the quality of it, which I think is interesting. It goes back to what we were saying earlier.
Quality is a separate debate, you know. I choose Italy every time. You know why, Alicia, it's good to see you. You're going to stay with us. We won't talk about that. Alicia Levine of BNY Wealth. Up next on the programme, we'll have more on the technology trade and, of course, the latest in the Middle East. We'll also get you an update on stories elsewhere this morning. With your Bloomberg brief, we'll catch up with Vonnie Quinn. Hey, Vonnie.
Hey, John. Chinese AI systems matching the performance of Anthropic's Mythos model in some scenarios. The Wall Street Journal reporting a new model by China's Zhipu, released this month, can match Mythos when it comes to finding security bugs. House Speaker Mike Johnson says he'll send the bipartisan housing bill to President Donald Trump to sign today. The president abruptly cancelled a signing ceremony for the bill last week to pressure the Senate to pass a nationwide voter ID law that he's been pushing for months. Former Disney CEO Bob Iger and Thrive Capital founder Joshua Kushner may be getting into the sports business. The two hiring investment bankers for a possible bid for the NBA expansion team in Las Vegas. The bid would be for a majority investment in the team. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, governing AI.
We've been talking to the government. We're very respectful of their recommendations. They're worried about counterintelligence risk. We're doing the best we can to open up Mythos to new cyber defenders.
Up next, we'll catch up with Bloomberg's Tana Kendall and have more from Alicia Levine of BNY Wealth. From New York City this morning, good morning. Equity futures positive here, just off session highs. We're higher by 0.8% on the S&P 500. On the Nasdaq 100 this morning, higher by 1 full percentage point. The Russell small caps outperformance last week alongside the equal weight S&P. The Russell this morning underperforms just a touch. We're positive by 0.3%. Let's talk about tech. Under surveillance this morning, governing AI.
The reason that we're giving Mythos to defenders before we give it to attackers is to patch all the bugs. We're doing the best we can to open up Mythos to new cyber defenders. We've been talking to the government. We're very respectful of their recommendations. They're worried about counterintelligence risk.
So here's the latest this morning. The Trump administration granting Anthropic approval to restore some access to Mythos 5, the country's top AI firms, responding as the White House continues to put limits on some of their top-tier models. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John. Well, this eases a clash that erupted about 2 weeks ago after we saw the Trump administration take really the unprecedented step to bar foreign access to Anthropic's most advanced models. In a statement over the weekend, Anthropic says that the company received notice from the U.S. government that Mythos 5 can be redeployed to a, quote, small group of cyber defenders and infrastructure providers. A person familiar with the matter tells Bloomberg News the company is in talks about access to Fable 5 as well, and the goal is to have both available for general use again. Now, it's unclear what steps Anthropic took in order to satisfy the U.S. government's safety concerns, though the U.S. Commerce Secretary Howard Lutnick said that significant progress was made. Now, this does mark a thawing in relations between Anthropic and the U.S. government, but tensions, of course, still remain, considering that this dovetails with what has become a bitter, months-long feud between the two when it comes to the military use over Anthropic's AI tools. And John, Washington's relationship with this company is having ripple effects across the industry. In fact, we saw on Friday OpenAI move to limit the release of one of its new models under pressure from the Trump administration. Both companies, Anthropic and OpenAI, are now urging this Trump administration to codify some sort of process when it comes to reviewing and the release of new AI models.
Tyler Kendall with the latest in Washington. Tyler, thank you. Introduce China. Step up China. One of the most read stories over the weekend from the Wall Street Journal. China has matched Anthropic in cyber security.
There are a couple of ways to read this. On one hand, people are saying that because the U.S. restricted Mythos and Fable, people are saying, well, why don't we just go to someone who won't restrict it, which is the Chinese open models, and there is less potential policy risk from an internal procedure process. Imagine if you had some sort of AI tool deployed and then you had to withdraw it suddenly because it was banned by the government. So some people are saying it's something of an own goal, and other people are saying, well, the Chinese technology isn't there enough, but it's good enough to effectuate some sort of proliferation. These are the two sides of a story that people are looking at and saying it's a national security concern and it's a business concern about who's going to shift over to China.
China is certainly narrowing the gap, which is why other people are coming out and saying this administration needs to do more in terms of export controls, in terms of chips and other materials China needs to create models like this that are up against Mythos and Fable 5.
Well, geopolitics, one point, price the other. And price is an important part of this conversation as well with regards to China.
Yeah. There are people, including Microsoft, that are heading to Chinese models because they're cheaper. And if the Chinese models can do what the U.S. ones can for the most part, even if they're not the most cutting edge, why wouldn't companies go over there if there's a price issue? And isn't this kind of the Chinese model? You can say that they deduced some of these models, whatever you want to say, but it's to reproduce it, make it as cheap as possible, and proliferate throughout the world, even if it isn't quite as good as the latest models.
Alicia Levine of BNY Wealth still with us. Alicia, just to build on this conversation, is there some signal in the reaction to price over the last few months?
Yeah, I mean, I think that's what you're seeing also. I mean, if you think about the original AI beneficiaries here, they haven't gone anywhere, right, in terms of stock price, because there's a sense that the top of the S-curve is here, right, that you have the ramp period and you're here. And if you have the Chinese model available, but the interesting thing is it gets back to the bigger question of, well, the reason we're pressing on this is because we don't want the Chinese to get ahead. So it turns out that conversation is actually the right one. That is the right one to have, and that is why we have to push so hard. It's a conundrum here. I mean, the government, I would hope, has the right expertise to know what it is to limit or not limit, but I think the threat from the Chinese models is very real.
How different is it to invest in artificial intelligence at a time where it's domestic priority, it's national security, it's something where you're seeing nations around the world trying to double down and finance themselves?
Like sovereign AI.
Yes.
So I think there'll be insatiable demand for this. It clearly has defense implications. We know that. I think we've seen that in the most recent hot wars here, both in the Middle East and in Europe. And that is going to keep the demand going. I think there's a sense of it's a smorgasbord and you have to take it all right now until you know which models are the right one. I think as it relates to what we've just been watching, there's a sense of a back and forth. Some of the companies have actually been more open about trying to limit it than others. Some think that's a political way of doing things, trying to be the one that's trusted, because if they keep on saying you have to limit us, well, you must be trustworthy. I'm not sure that's actually the case.
That said, the more this is sovereign AI, the more the spending really is coming from the governments, right? I'm not sure exactly where the financing is going to be behind SK Hynix and Samsung and their potentially 4 or 5 fabs. At the same time, some of it's going to come from backstops that are sovereign. At what point does this make you really concerned about the bond market? Because we are spending so much money, and it seems to be insatiable, and it seems like governments around the world see it as an existential risk not to. That how can't you expect this just to be a flooding the zone kind of moment?
So this issue of national spending on AI piggybacks on the global debt issue, right? So you have bond yields higher everywhere because we haven't actually gotten out of that COVID moment where every government spent a lot to support economies and never really got inflation back down to under 2% anywhere. I mean, every developed economy, inflation's close to 3%. And that's because we're just letting it ride. And this is the problem. The problem is that this spending issue is coming on top of all the excesses that we had during COVID that really have never been taken care of. Very hard to spend anywhere and then to take it back in the form of austerity. I mean, this government tried to do it in early 2025, and you saw how long that lasted. It lasted 6 weeks. So you're building spending. And so when we're talking about like correlated risk, yes, the corporate bond market, the equity market, U.S., emerging markets, sovereigns, it's starting to feel a lot around the same. Now, that doesn't mean something bad's going to happen. It just means that there is a sense that there's a moment in time that you have to invest in this because you can't be left behind. And if you can't be left behind, you have to spend.
It also shows, and you noted, that oil prices are not the determining factor of where yields are trading.
Now, the most fascinating thing is when the MOU was signed, oil dropped 12%, and the 2-year went much higher, right? Went higher by 20 basis points. So that's the most fascinating thing. What's telling you is that oil prices can drop. Yes, the headline inflation is going to drop, as you had in the previous conversation before I came on set. But the inflation now is likely embedded in core, and maybe not from oil prices, but from the spending on AI and the chip sector that's going into all the consumer goods. So now you've got a core inflation problem, which you didn't have when the war started. And so that's why the hikes you're still being priced in by the bond market. I don't think you get more than one hike this year, in the sense that because it's a Kevin Walsh Fed, it's not a Powell Fed. He said he's going to break with tradition. I think he could hike once and be done. Like in previous Feds, it was a cycle, at least 2, either cutting or hiking. You could probably get 1, but it is helping the long end very good. But the front end's telling you there's a hike this year.
Alicia, it's always good to catch up. Thanks for being here. Alicia Levine there of BNY Wealth. The president active this morning out on social media just moments ago. Gas prices are coming down fast. Report any abuses at the retail level.
So basically, once again, going after the actual gas stations if you see that prices are elevated for what he thinks it should be. Also, the president out with another Truth Social post about WTI crude at $69 and heading down. This is less than it was prior to the start of the denuclearization of Iran. So I guess the president in this other truth is claiming that Iran has been denuclearized, which isn't true because they're about to have conversations, technical conversations about this point.
Energy's moving. The relief starts upstream, and then it takes a while to address the scarcity in product further downstream. It's a process. It doesn't happen overnight.
It's Joe at Sunoco. Why aren't you doing it on the stop over there? Lower the prices, Joe.
Yes, just not how it works, right? Up next, Neil Cristiana of JPMorgan on the first true test for USMCA. Live from New York City, welcome back to the program. 5 days, no gains on the S&P 500. There's a reason I keep saying that and not a 5-day losing streak, because on Friday we were lower by 0.05%, Thursday down by 0.01%, Wednesday down by 0.1%. 3 of those 5 have been really, really muted losses.
Yeah, buy the dip, 0.01% loss. Buy it, get on in there. Look, this has been a range-bound market amid a huge churn under the surface. And that, I think, is the real story, and you've been pointing to it. The idea that you have seen some souring on some of the tech names, or at least volatility, even as you see a chugging forward of the equal weight and of this broader base rally that people are seeing as still having legs.
So here's the bounce on the large caps this morning, up by 0.8 on the S&P, on the Nasdaq 100 higher by 1.15, going into a week full of economic data, including payrolls this coming Thursday. You'll hear from the Fed chair as well, Kevin Walsh, speaking in Sintra, Portugal. That's Wednesday morning. In the bond market at the moment, 2s, 10s and 30s shaping up as follows. 2s, yields just about unchanged at 4.1%. 10s around 440 at 437. There has been a reset lower in this curve. 2s away from 420, 10s away from 450, 30s away from 5%.
Last week, two-year yields dropped by 8 basis points. This came after the Fed's meeting, where they evidently took a hawkish tone. So go figure. This is a market that is saying, we hear you, Fed, and we don't believe you. We're going to look at the oil story, and we're going to look at what potentially could come down the pike with disinflation and a potential peak in the inflation carry.
Let's look at the oil story. It's a bounce this morning, up by 0.8%. But speaking of resets, a massive reset lower from triple digits not so long ago to 72 on Brent and 69 on WTI. And the president is noting that he'd like to see retail prices come down even faster.
Yeah, so in this latest truth, he's not actually going after the name brand oil companies. He's saying it's tell the retailer that you're buying your local station that, you know, prices should be down. To your point, Jonathan, and experts will tell you there is a lag when it comes to oil prices to gasoline prices.
There will be a conversation, according to the president, with Iran, saying this morning, which contradicts to some extent what we heard from Iran, that Iran has requested a meeting. It will take place tomorrow in Doha. That crossing just seconds ago from the President of the United States.
So we were expecting going into this week to have technical talks about the memorandum of understanding, the 60 days that this memorandum of understanding has given in terms of having these talks about a more lasting peace agreement. But then, of course, just before 6 a.m. this morning, when we came on air, local media reports in Tehran were saying there were no discussions. Well, the president says they are, and that likely means that a Jared Kushner or Steve Witkoff is making their way to Doha.
It's difficult to keep up, which is why so many people have been ignoring this now for a number of weeks. And even more reason to ignore it with crude back down to the 60s on WTI.
There is a signal here, which is that President Trump wants the talks to continue, and that reluctantly, on some level, Iran is coming to the table in some capacity. The idea is that people are seeing this sort of messy middle as being the status quo for a while, and that's enough to keep prices where they are and then to move it on.
You mentioned earlier the Deutsche Bank survey. 75% believe that the Iran conflict will now largely fade, occasional volatility. 13% say completely fade. Wall Street has completely moved on.
Is that a forecast or a hopecast? Something of one or the other, I think.
I think that's
a good question.
Right. You know, honestly, it's a hopecast. I think a lot of people are just hoping this fades into the background.
That hope started a long time ago. 2 hours away from the opening bell. Let's get to your single name story this morning. Your morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start on some breakup news with Comcast shares soaring more than 23% in the pre-market after it announced this morning that it will split into 2 publicly traded companies. Comcast will keep its wireless and broadband business, while NBC Universal and Sky will spin off into a different media company. The thinking is that each company can focus on navigating their respective industries, very different, that are very much changing at this time. Meanwhile, we are seeing Nvidia and Palantir gaining this morning, already up on some positive tech sentiment, but got this news in just the last hour that the companies are expanding their partnership to help U.S. government agencies run Nvidia's open source Nemotron AI models on Palantir's platforms. It comes as the U.S. puts a greater emphasis on securing the most advanced, the best AI models, but of course, as it continues to run into issues with Anthropic. And we end on SpaceX. It is edging higher this morning, up more than 2% in the pre-market after NASDAQ confirmed that it will join the NASDAQ 100 next week before the market opens on July 7th. That means index funds and ETFs that track the benchmark will likely be buying billions of dollars worth of this stock. The question is whether that will get SpaceX out of its rut since it's a blockbuster IPO. John?
Yahara, thank you. Thank you for the update. More from Yahara in the next hour. On our radar this morning, the US and Iran standing down after a weekend of military strikes. The president saying a meeting with Iran will take place tomorrow in Doha. Semi-official media in Iran saying no talks are scheduled. As we're having this conversation, this crossed from a Bloomberg subscriber to me just moments ago. Make it end. Elsewhere, the Supreme Court set to rule on President Trump's push to fire Fed Governor Lisa Cook. Justices will decide if Cook's temporary removal stands while Cook fights for her job. A decision is expected before the court's term ends tomorrow. And finally, South Korea's top memory chip makers pushing to get ahead in the AI race. Samsung and SK Hynix among companies pledging to spend nearly $900 billion on chips and data centers, with plans to rapidly expand production to meet demand.
Yeah, right now I'm looking at about $900 billion. The envisioned collective investment represents about 5% of South Korea's total GDP in 2024. So this is a massive investment. And really what I'm looking at going forward is just how much we end up seeing these domestic initiatives come from the government. Right? Like, I don't have a clear sense when I was reading this, did you, of who's financing this or whether this was SK Hynix and Samsung going to the broader market and saying, hey, guys, can you spare a couple $100 billion?
It sounds like it's one of these joint cooperations between the government and some of these companies, given the fact that it's also announced by the president, which also we are seeing similarly take place. Of course, this is age-old story in China, but also mimicking as well in the United States as they are having these discussions as well with AI companies and the stake, of course, in Intel.
A bit of a fight also about why we're in this position and we don't have this capacity. A back and forth, not naming any names, but maybe some of these companies, the likes of Micron, blaming the likes of Apple as to why they didn't build the capacity when prices were rock bottom, because these companies wouldn't pay up for what they needed to go and spend the money at the time.
Yeah, I mean, there's going to be a lot of allegations on either side. Either way, South Korea is saying, you guys can take that squabble somewhere else while we build out our capacities so that we can meet whatever demand is possible so no one can upend us. And we will have the backing of the government to do that.
Let's return to trade. Let's talk about this. Haven't talked about this in quite a while. USMCA facing its first test since being signed by the president in his first term.
The USMCA is the largest, fairest, most balanced and modern trade agreement ever achieved.
I would rather not have the agreement, but I may sign it. We do better as a country if we don't have an agreement.
The US, Mexico and Canada set to blow past the July 1st deadline to renew their trade deal. Nor Cristiana, the head of Latin America investment strategy at JPMorgan Private Bank, writing, the base case is an extension with modifications, but the tail risks are asymmetric and underappreciated by markets. Noor joins us now for more. Noor, good morning. Good to see you.
Thank you, John.
So refresher if we can. So it was NAFTA, became USMCA under the president's first term, and now he wants to redo the thing that he came up with in the first term.
The best agreement in the world, the way that
Makes sense of all of that for us, please.
Yes. So when NAFTA was turned into USMCA, a set of guidelines were put in place for periodic reviews. We're coming to that first periodic review. I think it's next Wednesday or Thursday, July 1st. And what it calls for is, if there's no agreement between the three parties, it goes to another annual review, and another annual review, and another annual review until the agreement expires in 2036. If there is an agreement, the whole USMCA can get extended up until, I believe, 2040 or 2036.
Another 16 years.
Yes, exactly. So right now we're basically faced upon these check-in. I would call it more as a check-in between the three parties. Do we all agree with the same terms that were negotiated upon 6 years ago? Or do we need to tweak something? Or do we need to really change things and bring this review into a whole renegotiation? That's where we stand.
What are you expecting?
The reality is that what we are anticipating is very little modifications, and that this review will basically kick the can down the road for another annual review. There's very little insight right now that we're having any sort of agreement between the three parties, which means that July 1st will come. We're going to have the three countries sitting together saying we didn't reach an agreement. And this will take us down into 2027 review and then 2028 review if maybe.
Briefly, what does every country want changed?
There's different things. For US and Canada, for example, a lot of it has to do with energy. Between Mexico and the US, there's a lot of concerns around transshipment, especially as Mexico brings on exports or imports from other countries, particularly China, assembles in a different fashion, stamps on the label made in Mexico and then sends to the US. That's a big thing. And the other one that is very important is all the reforms that have been taking place in Mexico in the last couple of years have challenged to some extent the rule of law or investor certainty precautions that were included in the original USMCA.
Individuals, business, C-suites definitely want clarity. I was with the president in Wisconsin when he was addressing farmers. They want clarity, desperately want clarity on an issue like this, given corn goes to Mexico and the likes of agriculture up to Canada. How do you see this playing out in terms of level of clarity, in terms of, is it going to be like Liberation Day where we get whipsawed every day by headlines with USMCA? Or is this going to be one of those stories that just kind of fades into the background?
I think it's going to fade into the background when it comes to markets, but it's not necessarily going to fade into the background if you're a farmer exporting to Mexico or if you're an auto producer in Mexico sending auto parts or cars to the U.S. That's definitely not going to be the case. What has happened so far and what has happened for the last couple of years is that a lot of the investments that were planned out to happen are being pulled back, are being paused. And the risk of that happening is that right now we're running, and you guys know these really well, we have been running in an economy that's CapEx driven for basically 2 years. CapEx that is very much dependent on all the AI boom. Well, that AI boom is also partly dependent as well on what happens with exports and imports. Mexico became the largest exporter of advanced technology products to the U.S. in 2025, and very few people know that. So, yes, maybe it's not going to be overnight, it's not going to be from one day to the next, but at some point, if there is more uncertainty playing out in terms of how easily can you bring in Mexican exports, this could even impact the CapEx boom that we're seeing in the States.
Where in markets is this risk mispriced? Not necessarily on July 1st, but over the next couple of weeks and months.
Industrials, mainly auto, aerospace. That's where we're seeing the biggest risks.
That they're
those are the sectors that are the most reliant and dependent on the agreement to continue.
Is that a Mexico-Canada problem or a U.S. problem as well?
It is a U.S. problem as well. Trade with both Canada and Mexico represent 5% of the U.S. GDP. It's not little.
No, I appreciate it. I would say I'm looking forward to talking about this, but I'm not looking forward to talking about this because this could go on for weeks and weeks and weeks.
Well, when it comes to some of these policies, it seems like the never-ending story that never has a conclusive or satisfying finish. This is a concern, though, and to Annmarie's point, I think it's a really good one. The lack of certainty around this, it gives a real pause to people who are trying to plan, especially given supply chain resilience and the concern about the lack thereof recently.
When did this flip? When did this change? When did the president become unhappy with the deal he came up with?
I think when he stepped back into the Oval Office for round 2. It was the best deal until he can get an even better deal. I also think, to Noor's point, things have shifted. We are bringing in more imports from Mexico. That's the nearshoring effect from trying to de-risk supply chains from China. Maybe the president thinks he can get better deals when it comes to USMCA. But that lack of clarity is going to be a problem for a lot of individuals, especially farmers.
No, Cristiana of JPMorgan Private Bank. No, thank you once again. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump saying Iran has requested a meeting. Trump posting on Truth Social the two will meet in Doha tomorrow. The announcement coming just 90 minutes after Tasnim, Iran's semi-official news agency, said no talks were scheduled for this week. France recording about 1,000 heat-related deaths this week. The French National Public Health Agency saying 85% of the deaths reported since Wednesday were people aged 65 or older. The government earmarking $114 million in emergency spending to buy air conditioners, fans and other equipment for hospitals. Lionel Messi making World Cup history. Again, becoming the first player to score in 7 consecutive tournaments. Messi recording his 19th World Cup goal in Argentina's 3-1 victory over Jordan on Saturday. His record now is 123 international goals in 202 appearances. And that is your Bloomberg brief. John.
Ridiculous record. Vonnie, thank you. Just records being broken all over the place at this World Cup. Up next on the programme, plotting out a rate hike.
Core inflation is moving sideways or ticking up now. That's concerning. Going forward, might we have to raise rates from here? It is certainly possible. That's why I penciled in 1 dot. But we need to see how some of these other dynamics play out.
Up next, Steve Englander of Stand Sharp. Here's your bounce back this morning on the S&P, higher by 0.9%. On the Nasdaq this morning, large cap tech making a comeback, up by 1.2%. On the S&P last week, first weekly loss since the start of the month. On the month, down by about 3% on the quarter. A few more days of that left on the quarter, higher still by close to 13% on the S&P 500. It would make it the biggest quarterly gain we've seen going back to 2020. Switch on the board and get to the bond market. 2s, 10s and 30s. We'll talk about rates in just a moment. Yields unchanged on 2s at 4.1%. Crude basically unchanged this morning as well. WTI and Brent just getting notification from the president that there should be a conversation between the US and Iran tomorrow in Doha. Brent at 72, WTI at 69. You know how this goes. Strikes over the weekend and then talks as you start the week.
Yep, and so the truce, the memorandum of understanding of 60 days is hanging on somewhat by a thread. We did see an uptick in vessels. Now that's tempered just a little bit, even though it continuously does move. The president says the talks are on, which is different from what we heard from the Iranians very early this morning, which said they did not request this meeting and there are no technical talks. We'll have to see what happens in Doha tomorrow.
Crude, 72.41, and Bramo wants absolutely no part of this conversation. Just like so many of you at home want absolutely no part of this conversation.
Nope, not at all.
The cynic in you believes that maybe the back and forth is lined up with market hours on the weekend, strikes, and then we start the week.
I mean, is that a question?
Right.
I mean, yes, and also the idea that, like, keep the heat on, but not too much, and perfectly calibrate, and ultimately this is the reason why people are moving on.
It's Monday. The market's open, so there must be talks tomorrow morning. The surveillance this morning plotting out a rate hike.
The U.S. economy has proven to be much more resilient over the past year than I had expected. Inflation is still too high. Core inflation is moving sideways or ticking up now. That's concerning. Going forward, might we have to raise rates from here? It is certainly possible. That's why I penciled in one dot. But we need to see how some of these other dynamics play out.
So here's the latest this morning. Investors bracing for a slew of economic data due out this week as the Minneapolis Fed President Neil Kashkari warns rate hikes might be necessary to get inflation under control. Steve Englander of Stanchart expecting the central bank to remain steady, writing Fed Chair Kevin Warsh will hold the line on tightening if imbalances are not growing quickly, and Fed hawks will not ease until disinflation progress is clearly visible. Steve joins us now for more. Steve, good morning.
Hey, good morning.
Is that view becoming increasingly contrarian, that they can hold the line through the rest of the year?
You know, we've had that view for a while from late last year. And at the beginning of the year, we were the most hawkish on the market.
We were price-setting cuts.
Yes, and now we're among the most dovish. I think the key issue is that whatever imbalance there is, it's not growing very fast. So it's like your doctor telling you, yeah, disease will kill you, but it might be in 50 years. I mean, there's nothing to do right now. And I think that that's the stance that they're going to take until they just see which way it breaks.
So you're at no change, but some people have seen a change in the data and a shift in the reaction function. Why would you push back against both?
Well, because you might be wrong. You know, it's one thing to say, OK, let's do some insurance hikes. And we've written that Bernanke and Yellen probably would do some insurance hikes. But if you do those, you have to be ready to take them back, right, if it turns out that they're a mistake, because you're doing it in anticipation of something. You know, from what Warsh has said, he's more the steady hand type. He'd prefer to wait and see that there's a need to sort of take policy in one direction or the other. The other part, I'd say, is that unit labor cost, which no matter how hawkish you are at the Fed, is like super core inflation. It's the basis of domestic value added inflation, is really low. It's well below 2%, and it doesn't matter whether you take it over a year, 3 years, 4 years, it's well below 2%. So the risk you're taking is that core inflation goes from maybe 3 to 3.25, 3.5. You're not taking a risk that it goes to 5.5.
Are we being too cute about this? I mean, at a certain point, they said they need to get inflation down to 2%. They've missed it for more than 5 years. Inflation's too high. People hate inflation. This is their one mandate. They're not talking about the employment market. Are we being too cute saying, well, but maybe they're not being that hawkish? Maybe they're just going to sit on their hands?
Well, look, I think the productivity story is real. And, you see it in the numbers. The productivity has picked up. And it started picking up well before we all had AI on our phones. So it's a broader technological thing. I mean, you began to see evidence in 2023, 2024. That's a big factor in keeping a lid on inflation. So there's a case to be made that, yes, the numbers don't look right, but patience may bail us out.
Bail us out
not necessarily at 2%, but maybe at 2.5% or 2.9%, right? I mean, essentially, at what point do you expect Kevin Warsh to shift away from the 2% goal in some sort of strict fashion, which potentially he could hint at with the potential drivers of inflation in that task force that someone might be leading on that particular issue?
Well, it's hard to see that there'd be a good reason. 2% is arbitrary. 1.5% is a nice number. 2.5% is a nice number. But if you have 2%, you have to explain why 2.5 has suddenly become better. And I think that that's going to be a hard explanation to give. I think the case, and they used to talk about this opportunistic disinflation, that you don't hammer the economy, but you sort of, hope that you get a break. Don't let inflation go up. But if you get a productivity shock or downward shock to prices, you take advantage of it and use that to ease your way to the target. It's not crazy to want to say, look, we should do an insurance hike. But as I said, you have to be willing to take it back if it turns out to be wrong.
You keep using that phrase, insurance hike, but we had insurance cuts. And some people think we're just going to take them back. But this is not an insurance hike. It's taking back the insurance we already took out on the labour market.
I guess, but the labour market isn't booming. I mean, it's okay. I mean, there's no sign that any of the imbalances in the economy, either on inflation or activity, are big or growing fast. So what's the case for not waiting?
Well, Steve, do you think that they've been given more time because of the fact that we've seen oil prices come down?
I think that's part of it because, our latest version of, what we call core inflation takes out airfares, for example. The higher energy spills over into core through one way or another. So, again, if there's no emergency, it's worth waiting, we think, to see how things play out.
What's the FX call, Steve?
We're dollar positive. We became dollar positive on the back of the productivity theme last October.
So you get a Fed that surprises dovishly relative to expectations, but a dollar that's still positive.
It's capital flows. That if we get the productivity growth that we think we're going to get, if AI turns out to be as big a driver, although it's not all AI, U.S. has some advantages. Labor market flexibility, a capital market that can take funds. The capital will flow in. And as we've seen over the last couple of weeks, real interest rates coming up on the back of this is a very strong driver of the dollar. So we don't think it's the cyclical part that at the end of the day is going to drive the dollar higher. We think it's the structural part.
Interesting. Steve, it's good to see you. Thank you, buddy. Steve Englander there of Standard Chartered with the case to keep rates on hold through the remainder of the year ahead.
And a lot of people believe that to be the case, at least based on equity valuations, because some people say it might not matter. Other people say it just isn't going to happen, which is the reason why things have been priced this way. This is going to be a really interesting debate. Sintra's going to be quite fascinating to see whether, Kevin Warsh leans in, leans out, whether he goes for a hike.
The problem also, too, with how they view inflation is they really do need to hit their 2% target.
You see what's going on here?
Yes, I do.
Don't take this seriously. You see what's going on here? Bramo, you should have started this last week.
I know.
Then you would have had the chance to go.
She wants some pastis.
I missed it.
Trying to beat the drum about how important Central Portugal is, right?
Let me look up flights for you. You can take an overnight tonight, I'm sure.
You're trying to send me away?
Make it happen,
I'm doing
Bramo.
you a favor.
We'll take the show. Coming up tomorrow.
Fabulous.
We'll be in Central Portugal.
I think that would be great.
Coming up next, we'll catch up with Jim Caron of Morgan Stanley, Amanda Lynam of Goldman Sachs, Mike Darda of Roth Capital, Manish Kabra of SocGen. The third hour of Bloomberg Surveillance. Up next.
We've had an incredible run in a lot of these stocks.
Investors should be aware that things can change quickly.
If we have a change in narrative within the AI story, it can create exacerbated moves.
That frenzy is dying down around the AI trade in general.
There are going to be periods of digestion.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Annmarie already booking flights into Portugal.
Yep.
Landing tomorrow morning. Leaves this evening.
We have two options.
There you go, two options.
You can fly either at 8 p.m. or 10 p.m. and it's a direct flight.
Okay.
Make it in time for a pastis.
Nice.
And then we could do the show.
Sounds like Bramo's already booked.
Yeah, well, I mean,
ready to go.
She was my travel agent. Thank you.
You're welcome.
Equity futures this morning positive by 0.8% on the S&P, up by 1 percentage point on the Nasdaq 100 this morning. In the bond market, 2s, 10s, 30s, yields look like this, just about unchanged. 2s around 4.1%. If you are just joining us, this is why we're talking about Portugal. Coming up later this week, Central Portugal, Fed Chair Kevin Warsh speaking Wednesday morning on a panel following, let's say, some very vague comments at the last news conference of the Federal Reserve?
A lot of uncertainty, certainly, around the reaction function by the Federal Reserve, based on the fact that he really didn't give any and said that there are task forces for this. Nonetheless, as you pointed out earlier, John, he said he wasn't going to speak unless there was something to say. So, ostensibly, there will be something to say on Wednesday. What I'm watching is the divergence between the U.S. and Europe when it comes to oil prices and just how much of a reprieve you really are getting from oil prices having come down. The speculation is that it will be more of a reprieve for the United States, arguably, even than Europe, which still is working through some of the ramifications. So look at the divergence between Christine Lagarde and Kevin Warsh.
Europe's still struggling, plus they have much higher taxes, so they're not going to feel it at the pump the same way the United States is. The president, though, still taking issue, clearly in his Truth Social post this morning, about how some of these retailers aren't bringing prices down fast enough. But the fact of the matter is the energy is moving. According to the president, which is very different from what we heard from the Iranians earlier this morning, the talks will happen this week, and they're taking place tomorrow in Doha.
Kevin Warsh is in a very different seat, to your point. He's overseeing an economy right now going through a capex boom, experiencing a positive earnings shock, something we haven't seen together for a long time. And in many ways, some people might say that gives them the luxury of focusing on one side of the mandate. They can just look at inflation right now. And that's why things have changed to this Federal Reserve. Last year, at the end of last year, at the end of the year before that, this anxiety around the labour market. And they started to look through above target inflation. It feels like that's flipped in the last few months.
Which is why you hear so many people talking about taking back insurance cuts. Those insurance cuts were made, 75 basis points of cuts, because of the labor market that appeared to be souring. Now that it's firmed up and you can have a bigger focus on inflation, do you just color it, characterize it like that, and potentially even just do one or two and say, look, we're resetting the stage, we're just taking back what we gave?
Lots of data this week as well. Jobs tomorrow, ADP on Wednesday alongside ISM. Thursday, of course, payrolls and jobless claims. Coming up this hour, we'll catch up with Jim Caron of Morgan Stanley with the equity rally looking to get back on track. Amanda Lynam of Goldman Sachs on navigating disruptions in software. And Manish Kabra of SocGen raising his year-end price target on the S&P 500. Another one. We begin this hour with stocks bouncing back as the tech trade looks for stability. Jim Caron of Morgan Stanley writing, we're positive on the AI build-out, but recognise it will come in phases and will be volatile. We are adding AI winners as a key active view. Jim joins us now for more. Jim, welcome to the programme. I want to start a few steps back, if we can, before we get to the news of the moment. Your framework for where we are in this market. A new regime, shaking off the shackles of the post-GFC regime, what that means for nominal growth, what that means for the way we think about this Federal Reserve, and how we look at this market.
Yeah, so really what we believe that we're in is a period of higher nominal growth, which means that you're likely to have higher interest rates, but that doesn't necessarily mean it means it derails growth. So look, we had some GDP revisions that came in last week. Nominal growth right now has been revised up to 6.1% year over year. That's a pretty healthy number. What that number does is it drives earnings. This is one of the reasons why we're seeing earnings so strong in the U.S. right now, and it's keeping the equity markets, relatively high. But it also does have the specter of higher inflation. So then the question becomes, does higher nominal growth, does that necessarily mean that you're also going to have persistently high inflation? It probably means that inflation will be above target for a period of time, but it's not to the point where I think it continues to accelerate, much higher and it becomes destructive. So overall, I think what we're in is a positive, much more of a positive equity market versus a bond market. Bonds are going to have to struggle with this above target inflation regime, and central banks and the Fed in particular potentially hiking rates this year, although we don't think that they will, but potentially. This is something that's going to be a headwind to bonds, but it's a tailwind for equities because it boosts earnings.
So where in equities? So Jim, let's spend some time on that. So to your point, we had a scarcity of growth coming out of GFC. It pushed us into fixed income, supported by very dovish central banks with very dovish reaction functions, and it pushed us to seek out growth in equity. Growth equities really outperformed. What performs on the equity side of things with all of that in mind?
So there's a very blurry line between growth and value these days, because many of the companies that we thought were growth companies have now become value companies because of what they've done in, over the past couple of years. The way that we want to think about this is we believe that there's a very large technological revolution that's going on. We all talk about AI and higher productivity, but the reality is that many companies can participate in this. So the way that we think about this, it's going to be the adopters of technology, the people who are spending on CapEx, but also creating operating leverage within their own companies to generate higher earnings. So is that a growth company? Is that a value company? I think it's a little bit of both. So when I think about this overall, what it really tells me is that there's likely to be a broadening of the market, and there are going to be sectors like, for example, healthcare, which I think is extraordinarily inefficient, which can be a very big beneficiary of many of these technological innovations, and is also very well valued. The consumer sector, one of the things that we think about is the consumer, how everybody's been very worried about the consumer because of higher oil and gasoline prices. Well, maybe that's coming down now. The initial conditions in the markets were strong. Jobs data is still reasonably strong. And I think that's also a very undervalued segment of the market going forward. So I'm going to start to think about how the technological innovations start to compound broadly across the markets. And I don't want to get pinned down into growth versus value, because I think it's really a stock picker's market, but you need to find the early adopters who are leveraging the technology to create the operating leverage.
Jim, I hear so much about leverage. This build out is going to require so much borrowing. At a certain point, are you really trying to stay away from the fixed income side of things, or at least underweighting it more significantly as a result of the build out hinging on more leverage and, frankly, inflation being sustained at an elevated level?
Yeah, so it's a great question, right? So, and it gives me the opportunity to clarify. So we are underweight duration in fixed income because we do believe that we are in an environment where inflation is going to stay above target and it's going to be hard for rates to come down materially. However, a lot of the leverage that's being created, a lot of the debt issuance that's being created are from some of these very large technology companies that have very strong balance sheets. So just because debt is coming into the market, we have to look at the quality of that debt. The debt quality is actually pretty high. That's one of the reasons why the credit indices, whether it's IG or even high yield, it's why those spreads are so tight. It's because the quality of the paper that's coming into the market is actually really high. So when you look at the balance sheets of some of these large technology companies that are coming to market in very large size, what you're going to find is that their debt levels relative to their earnings and to their cash flow streams it's relatively modest. I know the numbers are big, but these are big companies. So I'm not worried about the debt markets. In fact, what I'd like to do is have a little bit more credit exposure versus interest rate exposure. I think the duration exposure in portfolios is the tricky part, but so far the higher quality credit aspects of the markets are actually reasonably strong, and I expect there to be a relatively low default rate cycle in this environment as well. Again, nominal growth is going to boost earnings and cash flows, and that allows you to pay back your debt as well as have earnings for equity shareholders.
You've mentioned something a couple times, Jim, about you don't think the Fed is going to cut rates or hike rates rather this year. You think that they're probably going to remain on hold, and you're underweight duration, which seems to be the opposite trade right now of the market, which is pricing in at least one rate hike and potentially a bid into duration, possibly as a result of a more hawkish turn in the Federal Reserve. Why do you think this Fed isn't going to hike rates, given the rhetoric and given some of the shift in commentary?
So I think the shift in commentary is somewhat misunderstood. And you were talking about it earlier. People are talking about an insurance hike. Clearly, whenever you see gasoline prices, energy prices, some of the recent inflation prints that we've had spike the way that they did, as a central banker, you're going to say, well, I have to be cautious about these things. But the reality is that oil prices have come down a lot right now. We're not seeing the inflation pressures seep into the core levels. What measure of inflation is Warsh really looking at? He always talks about some type of a trimmed mean. And if you look at the PCE Dallas Fed trim mean numbers, they're around 2.4, 2.5%. I think a lot of the numbers that have gotten people worried are actually going to start to fade away in the second half of the year with energy prices coming down. I think the market is strong, and just because you have a strong labor market, let's say the unemployment rate goes from 4.3 to say 4.1, that doesn't necessarily mean that you're going to have higher persistent inflation above 3%. You could still get back down to 2.8%, or somewhere in there, which I think is comfortable enough for the Fed to not have to hike rates and hurt the economy, while I do believe that we do have higher productivity, while inflation, I think, is still relatively in check.
Jim, though, if you were to change your thinking on this, what would it take? Would you have to see more of that inflation creep into core?
Exactly right. If inflation starts to creep into the core measures of inflation, of the readings, and this starts to become persistent, then it's a different ballgame. And at that point, I'd start to get very, very nervous that the hand of the Fed will be forced to start to hike rates. But we're not really seeing that major shift into core. I think it's too early to go through a major rate hiking cycle at this point in order to address that.
Hey, Jim, it's good to see you. It always is. Thank you, sir. Jim Caron there of Morgan Stanley breaking down his thoughts just at the end there on this Federal Reserve. Conviction. Conviction's pretty low, isn't it? When you speak to Aditya Bhave over at Bank of America, talking about the 3 hikes they've penciled in for the year ahead, rather like Neil Kashkari, it's in pencil and subject to change through the summer based on the economic data we get and the clarity we may or may not get from the Fed chair.
Yeah, with a big eraser, and you could erase that. I mean, this isn't really guidance that you can really get any clarity around, given the fact that this Fed Reserve hasn't given us a sense of the reaction function, and we don't have a sense of which data they're watching. Aditya talking about everything backward looking. Okay, well then, how do you look forward? And that ultimately is going to be decided by a task force.
We're hoping to get some of that, at least, some of that, before the task force conclude whatever they're looking at. Some of that on Wednesday morning in Sintra, Portugal. Equity futures near session highs up 0.9% on the S&P, with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Comcast shares surging in the pre-market. The company planning to split its media and technology units into 2 independent, publicly traded companies. Comcast is expecting the separation to be completed in about a year. Anthropic winning U.S. approval to restore some global access to its Mythos 5 AI model. According to a letter seen by Bloomberg, Commerce Secretary Howard Lutnick wrote, Anthropic has worked with the U.S. government to address risks associated with the covered models. The Supreme Court will announce its decision on President Donald Trump's firing of Federal Reserve Governor Lisa Cook before the court wraps up its current term tomorrow. The court will decide if the president has the authority to fire Cook or was targeted over alleged mortgage fraud predating her term. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, the Morning Calls, plus Amanda Lynam of Goldman Sachs as private credit firms face risk from software. The conversation just around the corner. Live from New York City this morning. Good morning.
The path to 8K is the earnings, but you're going to get volatility. There has to be consolidation here. I mean, some of those charts are parabolic with the memory names. It's going to pull some of the market down with it just because they are the leaders right now, right? It's not the Mag 7, the Lag 7. You're going to have a rotation, but you're challenged probably on the index level for the next few months.
That was Alicia Levine of BNY Wealth. Let's talk about the Lag 7. Let's talk about 4 of them. This month, Microsoft down 17%, Meta down 13%, Apple down 9%, Nvidia down 9%. Those big names have had a struggle through the month of June.
This is the market saying we don't like how much you're accelerating your CapEx plans without a commensurate increase in your revenues, and saying, look, your business model has changed. This is what Alicia Levine was saying. Ultimately, how much does pushback result in them curbing their deployment of capital, curbing their CapEx ambitions versus, okay, you want to take our shares down? Go for it. Watch what we do in 6 months.
Let's get to the scores right now. Equity futures up. Session highs up by 0.9% on the S&P, on the Nasdaq 100 higher by 1.2% on the Russell. Fantastic week last week for the Russell, and the equal weight this morning, just a bit of underperformance. We're higher by 0.5%. Let's get you some morning calls. First up, Mizuho boosting its price target on Qualcomm, saying headwinds in its consumer business will be offset by data center revenue. Your second call from Cantor raising its price target on Texas Instruments, saying the AI infrastructure build-out is a durable and generational semiconductor cycle. And your third and final call from Raymond James, initiating coverage on AppLovin with a strong buy rating, 640 price target, saying the software maker is expanding into sustained growth from its e-commerce advertising. That stock is higher by almost 3% in the pre-market. Let's focus on software and turn to private credit. Liquidity concerns at the forefront as unease grows over the outsized role of software in portfolios. Some on Wall Street are pushing back.
We suddenly all start worrying about SaaS, software as a service companies, and you can't have it both ways. You cannot make the argument that these companies should be taken to the woodshed because their business models are going to be completely upended by AI. And at the same time start to say, well, AI doesn't make a whole lot of sense. I still think the upside outweighs the downside.
Amanda Lynam of Goldman Sachs weighing in, writing the following. We see scope for private credit to deploy its sizable amount of dry powder in response to potential dislocations. Amanda joins us now for more. Amanda, good morning. Good to see you.
Thank you for having me.
How much disruption have we seen in this space?
We haven't seen much so far. It's really been confined to a sentiment overhang as opposed to real disruption. Actually, we've seen some early indications of refinancing activity, which is an encouraging sign given the 2028 maturity walls are pretty steep. I feel like we have these episodic periods where we care more about maturity walls and less, and they're back into focus, which is a new development over the past few years. But I think two key points really stood out to us from our recent work on this. One, there's an investor perception that recoveries in this space would be really low in the event of a default. And actually, we looked at 30 software defaults from 2016 and found that recoveries are not that much worse than the broader market. So I think that's notable. And then second, we've emphasized the point that our equity colleagues have really been underscoring, which is that not all software is created equal. And so while we do expect some dispersion within this space, we do not expect broad-based disruption. But of course, the refinancing axis is key. The point you raised on private credit is also meaningful because that is, I think, a way to put a floor under potential dislocation.
We often see these major maturity walls. They come and go. They get refinanced. We moved on.
Yeah.
How big is this one? Just describe it for our audience.
I think this one is more sizable. I mean, it's nearly $100 billion over the next year and change, which is meaningful. I think what's different though is that, and that's for software specifically. I think what's different is historically there was a lot of focus on the maturity walls in the context of the Fed rate hiking cycle of the past few years. This feels a little bit different in that it's sector specific and there's a bit of price discovery on a topic where I think there's still a wide range of debate as to how disruptive AI might be on these legacy business models. So it was a little easier to analyze maturity walls in the years past because it was really just a function of the macro and we were figuring out would the capital markets remain open. Here we're trying to understand what is a paradigm shift with the AI technology, and I think that's been a little bit different for our investor base.
You might not have seen that much of a dislocation yet in terms of pricing. There is a question, though, about how much credit investors' attitudes have shifted in the form of demands for greater protections, demands for greater lines, potentially secured assets to tie to some of their loans. How much have you seen a change in terms of the covenants, in terms of the pricing for credit investors as a result of some of these concerns?
We've definitely seen that at the leveraged part of the credit universe, but I would say it's actually not confined to that universe. What we've seen is a little bit more of pricing differential, even in the high end of the IG rating spectrum for some of the hyperscalers and the tech issuance that's come to market. So it's absolutely a trend where I think the capital markets in general are quite receptive, but to your point, Lisa, investors are demanding additional protections. That could be amortization, that could be some additional equity contribution from private equity sponsors, that could be higher spreads. So that combination is really, I think, something that will stay with us for a while.
Do you expect an increasing number of companies to get left out of that, to sort of be deemed disruptible and potentially failures? Sorry, not to be harsh, but essentially, do you expect more defaults going forward as you see sort of the yellow pages of our time disappear?
So our view is that in the leveraged loan market, we've probably passed the peak in defaults for this cycle because keep in mind, in November of 2024, that default rate reached close to 8%. So it would be a high bar for us to get back there. To your point, just like in any sector, there for sure are folks that are more disrupted from this technology. I think the area where we would be most concerned are companies that are already low rated in the loan market or in private credit. They're towards the bottom end of the size spectrum, and also have a combination already of weak free cash flow and high leverage. That sort of financial mix entering a period of potential disruption just leaves them on the back foot. So for sure, you can see that already reflected. Moody's actually put out a piece that a large portion of their software universe is already rated B-, which is kind of at the cusp of CCC. So a lot of this is reflected in the price. I think the key risk for us is that we just need capital markets to remain open and discerning. And that's fine for corporate credit. The period period of time where they become dislocated is the environment where we would expect private credit to step in and deploy some of its capital, even though it already has exposure in some strategies. But there's nothing wrong with the capital markets being differentiating.
All of this has been concentrated on the sentiment overhang on software exposure. What other industries do you think also potentially could be hit with this kind of sentiment?
Sure. I would say your point is exactly right, Annmarie, that software is kind of the headline grabber, but we've also made the point that if you look under the surface of, say, healthcare, financial services, certain business services, they also do probably have a decent software exposure within those sectors, even though they're categorized as something else at the headline level, just because of the way that the businesses are. I think right now the focus seems to be on the potential disruption in software. If I had to expand it to other sectors, I would lean more towards beneficiaries. We actually published something overnight that commented how healthcare, for example, could actually be a beneficiary of AI in terms of drug discovery and regulatory filings. I think the key takeaway, though, is it's not yet driving spread performance in the credit sectors, but what we've said is that will probably cause us to have an upside bias to our supply forecast, because for all of the talk about supply from tech issuers, it's actually not limited to that sector. We're seeing a range of companies talk about AI investment, and we think at a minimum that will be needed to fund by some at least incremental budget.
Well, let's get to the incremental yield we might need to get that supply away.
Yeah.
Any sign of that pushback developing now?
Right now, with the 30-year and the 10-year, hovering at the high end of the historical range, we're seeing all-in yields for long-end IG at 5.75%. It's off the peak. It's still good enough in our own view to actually catalyze some of this yield-based demand. I think really what you need to see is at the sector level some incremental spread added to some of these deals. Now, we're seeing these kind of episodic periods of indigestion in the credit market. We're going to have a bit of a reprieve because we're in earnings blackout, so companies don't issue around the time of their quarter end and their earnings. So I feel like the market will pull back and tighten a little bit. But I think we should brace for periods and windows of heavy supply, especially subject to the whims of the market and sentiment, that there should be some more price discovery. And again, the point is this is a multi-year issuance cycle, not a small one.
And just a little bit of pushback to SpaceX in the last week, just a little bit.
Yeah, you saw hundreds of millions of dollars of market valuation taken off those particular bonds in the initial days of trading. I love how credit markets sound like a weather report. Periods of heavy downpour, heavy issuance, but they should subside into clear sailing and profit building.
There's a phrase in a British weather forecast I never hear anywhere else, and that's sunny spells.
I love this phrase.
It's my favourite line.
Yeah.
Sunny spells. You might see some sunny spells.
Yeah, you might see some profit expansion spells while you have a deluge in the supply.
Amanda, it's good to see you. Thanks for being here. Thank you. Amanda Lynam there of Goldman Sachs. Up next on the programme, Mike Darda of Roth Capital on why the Fed can afford to be patient from New York City. You're watching Bloomberg TV. The opening bell about 60 minutes away. Futures positive in this session. Highs up 0.9% on the S&P. On the Nasdaq up by 1.2. On the Russell this morning, higher by 0.4. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Comcast shares rallying this morning, up 23% after the company announced that it is splitting into two publicly traded companies. Comcast will keep its broadband and wireless business, while NBC Universal and Sky will spin off into a separate media and entertainment company. The thinking is that each company can better navigate its respective industries that are changing very rapidly. Meanwhile, we are seeing more deal news, but this time on the space front. Rocket Lab and Iridium shares are soaring in the pre-market after Rocket Lab announced it is buying the satellite operator in an $8 billion deal. And it's not usual that you see both the acquirer and the seller rallying on the news, but investors appear to like what this does for Rocket Lab, expanding it beyond just the company that launches rockets, and also following a similar playbook that's made SpaceX so successful. And we are seeing Microsoft, Amazon, and Meta on track for a second straight session of gains after a brutal June sell-off that's seen investors rotate away from these companies that have big AI spending plans. All three are down double digits as investors have rotated into the likes of Micron and other memory names, but we'll see if this rebound has legs. John?
A turnaround for some of those names this morning. Yahara, thank you. Appreciate it. Looking ahead to a week full of economic data and a key address from Fed Chair Kevin Walsh making his debut alongside global central bankers in Sintra, Portugal. Mike McKee has a preview for us. Good morning, Mike.
Good morning, John. Well, first week of the month is always the biggest for data, and then you take away a day out of that week and you got to squish everything in. So it is a big week. Not much going on today, except we do have that Supreme Court decision about Lisa Cook and whether the Fed president can fire Fed officials. Still hanging over us. Could come today, could come Wednesday, but likely it will come this week. Then on Tuesday, jolts and confidence. Gas prices are down. Is confidence going to rise a little bit? We've seen it go down quite a bit. On Wednesday is that Warsh meeting, Warsh event that you talked about, plus ADP and ISM manufacturing. Jobs is the focus. And Thursday we get that jobs report along with claims and ISM services. We'll be looking at prices as well for ISM manufacturing and ISM services. And in the jobs report, a lot of people want to see whether average hourly earnings move up at all. Now, about that Sintra meeting, the sort of European Central Bank version of Jackson Hole, it may or may not be a big deal. You'll see a lot on it, but it's about shaping Europe's future. And that panel that Kevin Walsh is speaking on also has Christine Lagarde, Andrew Bailey, and Tiff Macklem from the banks, the ECB, the Bank of England, and Bank of Canada. So we may not get a lot of guidance from Kevin Walsh on that. But with all the data and whatever we do get from Sintra, we'll all be looking on Thursday evening when the markets close in the United States to see whether the Fed is going to be raising rates or lowering rates according to market perceptions. You can see right there. Basically, we are looking at 30 basis points of increase by the end of the year. We'll see if that changes at all. And then we get Friday off, of course, because it is July 4th in the United States. And John, I heard this week, I did not know this, that really, that the British don't pay a whole lot of attention to July 4th in the United States. They don't even teach a whole lot about it in schools. It's much more things like Waterloo and the Napoleonic Wars are much more important because you're a slightly older country.
I don't remember it coming up in the curriculum, Mike. You're absolutely right. But as a guest in this great country, it's something I still mark and celebrate. So I'm looking forward to the long weekend. Thank you, sir. Michael McKee there, looking ahead to a week ahead full of economic data and Chairman Powell. Just on Lisa Cook, I think this is interesting. Do we find out that Governor Powell leaves either way? Because either Lisa Cook gets to stay and there's no reason for him to stay, or you can fire Lisa Cook and you can fire him too.
Well, that's one way to look at it, Jonathan.
I was joking about the last piece of it, but please.
I was thinking potentially, if the Supreme Court makes a decision on something, does that, in Jay Powell's mind, even if he doesn't agree, maybe personally, and I'm not saying this, doesn't agree with the decision, it's wrapped up. Can he now exit?
To be very clear about what the decision is, it's not necessarily whether he can fire her, it's whether he can remove her from her seat while the lower court deliberates on exactly whether there was cause to fire her. And that ultimately is going to potentially give the president more leverage. Does Governor Powell want to continue this fight forward in some sort of prolonged way? Is this sort of what he's waiting for? Is he kind of enjoying it? Maybe he's heading up a task force. These are all questions people want to know.
Possibly, I doubt it, but possibly. Look, this is why we're in this position, why we don't really know what Kevin Walsh stands for right now, because he has to defend central bank independence and carry on this effort from former chair, now Governor Powell, because of the pressure that was put on the institution by the White House.
I would argue that Chair Walsh reclaimed the Fed independence mantle pretty clearly during that Fed meeting by coming out with a more hawkish tone. And that definitely gave people faith that he was going to be independent, added to which the president really pulling back and not necessarily saying anything negative about him, saying, whatever, do whatever you want to do. Does it get sort of undone by this decision by the Supreme Court on its final days of these 7 last decisions? And ultimately, how much will that be a market-moving event?
What's the reaction to the Peter Cheer take? And if you're just tuning in, I mentioned this earlier, I'll share it with you again. Peter Cheer over at Academy wrote this, something a little original about what's happening over at the Federal Reserve. Imagine, it's easy if you tried, that Walsh convinced Trump that sounding dovish right now would be a disaster. Imagine again, it's easy if you tried, that he convinced the president to let me sound hawkish on inflation, that my hawkish message will control the long end of the yield curve. It did. That we will convince every reporter and Wall Street analyst to believe we're going to hike and fight inflation.
That's arguably what some people are saying is going to happen. And Peter Scheer thinks that there's still going to be a cut this year as a result of hawkish jawboning working. I would argue it isn't Kevin Warsh convincing the president. It is Kevin Warsh convincing Scott Bessent as they have these discussions. And Scott has really come out, Treasury Secretary Bessent has come out and talked about how, you know what, this is what has to be done. And right now we need to lean into this.
And
mandate.
Kevin Warsh convincing the markets. That's really who's going to be the one that pushes him and tests him and also tests the president. Even if this was true, and say it's a wink, wink, you know, this is what we're saying, but we're not actually going to do it. The president can't help himself. He's still going to go out there and say, like he did the other day, I think he said something like lower interest rates solve everything.
Let's get to the Mike Darda take over at Roth Capital. He writes the following: the Fed can be patient. The best thing Warsh can do is preserve the nominal stability enjoyed over the last 3 years. Mike joins us now for more. Mike, good morning and good to see you. They can be patient. Do you think they will be patient?
Thanks for having me on, John. I think they are going to be patient. New York Fed President Williams gave a very important speech, or really it was just prepared comments that were released last Thursday. And this was essentially his take, and the market did react to it. We did get some reduction in the pricing for forward rate hikes after that paper. And essentially what he argued is, despite the fact that inflation's above target, there's no denying that, the labor market, you're not really seeing any signs of overheating there. And his expectation was you've got a resilient economy and that inflation will come down, back down to target over time. I think the most important argument in favor of the Williams view is that the bond market is not really looking for these recent really high inflation settings to be sustained. Bond market inflation expectations actually have been coming down. As Lisa mentioned, you know, Warsh really kind of came out of the gate pretty hawkish, focused on price stability, slimmed down the Fed statement, pulled the forward guidance. So bond market inflation expectations are actually on the low end of the range now, 220 basis points at the 10-year horizon. That would be consistent with a 2% PCE deflator over time. So the Fed's highly credible in the eyes of the market, and that is critical given everything you guys have been talking about this morning.
Mike, forgive me, it's a little bit circular, but is it credible because people believe they're going to hike?
Yeah, I think given that what's priced into markets, right? I mean, these markets are changing every day and they're forward-looking. So right now, if you look at the expected path of the Fed policy rate, it's expected to move up, but not dramatically, right? 30 basis points or so over the course of the next 12 months. And the question is that, you know, consistent or inconsistent with nominal stability, price stability over time? You know, and the bond market is telling me that that would be consistent. And if anything, you know, they might even be able to be a bit more patient than that.
What data, Mike, do you think is going to have the biggest ramifications for the Fed? Is it going to be labor market data that comes out on Thursday? Is it going to be the next CPI prints? How much is there going to be some sort of predictable reaction function coming from this FOMC?
Yeah, great question. I think it's going to come down to the labor market, not just, you know, the tone and tenor of payrolls, but what happens to the unemployment rate. It's been dead flat, as Williams mentioned, over, you know, a bit more than a year now. What if we get into a situation where the unemployment rate actually starts to fall? And, you know, then I think you're going to have an interesting set of debates that starts to take place on the Fed. That would tend to reinforce expectations of rate hikes. Yet if expected inflation continues to be low or even falls further, that kind of cuts the other way. So I think the Fed's going to be patient in interpreting what's happening to the labor market. But that really will be the key going forward. If you do get into an environment where the labor market is heating up, you know, then I do think that the consensus probably hardens pretty considerably for starting to tighten monetary policy.
Mike, how closely are you watching the Supreme Court today for a ruling on Lisa Cook? How much does that matter for an economic call?
Yeah, I think it really does matter. I mean, we don't want the Fed's independence jeopardized in any way. And the good news here, and we'll see, you know, how this decision comes out. The good news is the Fed still has quite a bit of credibility in the eyes of the market. Should not be taken for granted. And it's pretty impressive considering all of the tampering that's been going on. And so I think anyone that cares about monetary policy and is focused on markets is watching this pretty closely.
Not to get too much into the politics, though, but to Jonathan's earlier point, if we get this Supreme Court decision, are you expecting Governor Powell to leave fairly shortly?
I don't have a call on how long Governor Powell stays. It's certainly up to him. Considering everything he said coming into this and his decision to stay on, I think he'll probably be there for a while yet.
Mike, you've seen the warning coming from the Bank of International Settlements. Tiff Macklem of the Bank of Canada has said something similar. Macklem will be sitting on the panel alongside Chairman Walsh later on this week in Sintra, Portugal, warning that a lot of concentrated risk is building up around AI, the capex, the build out, and that could be a market macro financial risk. Mike, do you share that concern?
Well, the way that I look at it is, and we kind of where we started with the preservation of nominal stability. Markets are going to sort all of this out. We have a lot of investors that are quite concerned about how big this capital spending boom is. $1 trillion potentially over the next year. What is the ROI on that? And so markets are going to have to sort this out. But does that mean that we're going to have some kind of financial event that totally upends the economy? And I think that's quite a different question. If the Fed does well at preserving nominal stability, then you could have big moves in certain sectors and it doesn't undermine the business cycle. So that's really the key point. So I'm not really seeing the big buildup of systemic risk. What I see is a backdrop of exceptional, incredible nominal stability. And we've had 3 years where nominal spending growth has averaged 5.4%. And yes, inflation's very high now as we've gone through these recent supply shocks with tariffs last year and energy this year. But as that settles down, I think we can look forward to a reorientation of nominal spending with stronger real figures and lower inflation numbers. And that's quite good. And as long as we have that nominal stability, then issues that happen in one sector or another are not going to undermine the entire business cycle.
Mike, good to see you. Thanks for catching up with us. Michael Darda of Roth Capital. Somewhere in Europe, it looks like, right?
Or,
Sintra?
fake Sintra.
Fake Sintra.
Well, I don't think that was a real background, but maybe he's there. Maybe that was actually
longing for a European vacation, just seeing that beautiful scene.
I think that
Mike Darda,
he was too.
You can leave tonight.
Clearly he is too, right, yeah. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn's with us with more. Hey, Vonnie.
Hey, John. President Donald Trump saying Iran has requested a meeting. Trump posting on Truth Social the two will meet in Doha tomorrow. The announcement coming just 90 minutes after Tasnim, Iran's semi-official news agency, said no talks were scheduled for this week. South Korea is orchestrating investments of at least $880 billion from companies including Samsung and SK Hynix Inc. into chips and data centers. The companies plan to build 2 chip-making plants apiece in the southwest to rapidly expand production capacity to meet increasing demand. Supergirl debuting at number 2 in the weekend box office behind Toy Story 5. Comscore reporting the latest superhero film from Warner Brothers DC Studios division, bringing in an estimated $38 million in North American ticket sales and cost $170 million to make. That's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Manish Kabra of SocGen, raising his S&P 500 year-end target to 8K. That conversation up next.
What we're in is much more of a positive equity market versus a bond market. Bonds are going to have to struggle with this above target inflation regime, and central banks and the Fed in particular potentially hiking rates. This is something that's going to be a headwind to bonds, but it's a tailwind for equities because it boosts earnings.
That was Jim Caron of Morgan Stanley weighing in on this equity market. This equity market bounced back this morning by 0.8% on the S&P. On the Nasdaq, higher by 1 full percentage point. On the Russell, up by 0.4. Just holding on to these gains ahead of the cash open, 42 minutes away. Going into the trading week, this is the week ahead for you. Tomorrow, JOLTS data, consumer confidence. Wednesday, ISM, ADP, plus this guy right here, Kevin Walsh the chairman of the Federal Reserve on Wednesday morning. Then it's payrolls Thursday. Bramo, that's a stacked week ahead.
Yeah, payrolls Thursday really going to be real key to understand just how much heat there is coming from the labor market, especially if we get any sense of what the reaction function is from Fed Chair Warsh. He is going to be at his first international meeting. It will be interesting to see what message he has after a rather, oblique one a couple of weeks ago.
Vague, to be fair, right? Vague by design in many ways, and we're all looking for more detail in a few days' time. We've seen a ton of price targets get kicked higher in the last few weeks. Wells Fargo, Barclays, JPMorgan, we've seen it from RBC just this morning. Manish Kabra of SocGen is one of those, boosting his year-end S&P target to 8K from 7,300, saying the upside risks include higher AI monetization and an easier Federal Reserve. The downside risks include a Fed-induced slowdown, curbing the capex cycle. Manish joins us now for more. Manish, welcome to the programme. That's quite a stunning upgrade from your price target. You're not alone, of course, Manish. Where did that come from?
Yeah, I think the first one is, is earnings for sure. When I say earnings, the earnings, in my expectation, it's running 1 year ahead. So I had $333 on the EPS for S&P for 2027. I have that now for 2026. So I think earnings is for sure like the biggest story. But as in what I would flag is, as an AI is the earnings driver, Fed is the multiple driver, and the questions have evolved. So one for sure has to take a view on the Fed at this point.
What's your view on the Fed at this point, Manish?
I think the view on Fed is as in twofold. One, if you watch inflation and inflation-related inputs, it's the most polluted index as of this point. So, you watch the supply side shocks that are there, the tariffs, the energy shock, the fertilizers, the food. And then once you add up all of those things, I don't think it's very, very, very easy at all to predict inflation. So I think for that reason, our call is, Fed will not do anything, almost for next 12 months and rather wait for signals. The other point, which is, can Fed go ahead of the curve? And I think this is where the big debate for equity happens. How do you define Fed has gone ahead of the curve? For that, you need real yields going towards 4% kind of territory. So this is what needed in 70s and 80s, when central banks were more inflation focused, real yields were near 4%, not near 2%.
What's the range of outcomes, Manish, if the Fed hikes or doesn't hike? In other words, you see 8,000 with the Fed remaining on hold. What happens if the Fed hikes once or twice, as so many people seem to expect this year?
As a net, I would say 1 or 2 hikes for sure. It would matter. It would matter for anything which is rate sensitive, the short duration sensitivity, the housing market. Of course, all of those things will have pressure. But broadly, if I again try to see, will this be enormous to get? When we call this whole tech AI capex, ultimately it's very traditional physical economy capex, as half of the capex goes into the real economy. And then you see a lot of signs. You see South Koreans announcing they have to spend more. And accordingly, small cap industrial seeing 30% earnings growth. I think the operational leverage is what gets underappreciated when capex happens in the real economy or physical economy. So, for sure, short-term negative if Fed does hike, but is it like big top for S&P 500? That's not something I'm expecting it to be.
On the flip side, how much do you expect pushback on pricing? I mean, some of the margins, you're talking about the earnings expansion and how it really has been from some of the tech names, in particular from some of the semis that have been able to charge whatever they want, and the hyperscalers have been on the hook to pay it. At what point do you see hyperscalers pushing back on both CapEx plans more broadly, as well as potentially on those prices?
Yeah, I think this is a fantastic question. So first, I would flag, let's just look at the whole tech sector as a big group. And when you see tech sector as a big group, it has given 9x returns in 10 years. So, very obvious, everyone has a lot of questions whenever you have seen something like 9x returns in 10 years. My whole take is, if you watch the whole sector, operating cash flow at all-time highs at 1.2 trillion, free cash flow, believe it or not, is at all-time highs. Of course, the message is you follow the cash flow, and following the cash flow, you end up, buying a lot of semis, you end up buying, avoiding the hyperscalers. So I think the pushback, if I have to see where my take is, and my whole outlook is called bullish, not blind, and the whole take on that is, if I see the second derivative of growth slow down, that's first half next year. And when do I see free cash flow inflection from hyperscaler? That's second half next year. So there's a lot of tension, rotation, reversals, all of that is there next year. The only risk I would say for that is, if hyperscalers, of course, get together and they decide, hang on, we need to get the pricing power back, and to get the pricing power back, they have to form a cartel. And the way to do that in a capitalistic economy, I think that's really tough.
Manish, we got the sense from Barclays that it was almost uncomfortable to have to do this again, to have to upgrade. Do you feel that way?
Not as much for the reason, when I'm watching, different things that I mentioned, small cap, especially small caps where, expectations were extremely low to start with, and suddenly you have 20% earnings growth. For small caps, S&P, 600 industrial, 30% earnings growth. When you add up those things, that gives you confidence on the operational leverage.
Manish, if you had to make a bet right now into year end, and forgive me for putting you on the spot, would you take the equal weight S&P or the market cap weighted S&P into year end?
So I have liked equal weighted S&P for 18 months now, and I still like it. I think that's your big position, because what does equal weight S&P offers? The biggest weight is industrials. Second biggest weight is financials. So, if you're buying America first, which is what I see from White House, I like equal weighted S&P.
Interesting. Manish, appreciate your time, sir. As always, thank you. Manish Kabra there of SocGen out of London this morning, looking for 8K on the S&P. That's up from 7,300. Basically had to pull forward. You heard him there. Had to pull forward a pretty bullish forecast on earnings to 26 from 27.
What I'm fascinated by is that everyone who seems to have upgraded their expectations says we're not blind. We do see problems, but they're 2027, 2028 problems. So right now you have to look at the numbers and respect them and lean in. And that's essentially the bull case, and that's what we see coming to fruition.
Absolutely. Just pretty much have to lever up now, go all in, and just kind of worry about it in 2028. It's a kick the can down the road situation, but they're actually seeing the earnings improvement, and we're hearing it across the board.
We've seen it from bank after bank after bank after bank over the last few months, haven't we? Manish saying bullish, not blind on the S&P 500. He's not alone. We've heard the same thing from other banks as well. And they're scrambling to keep up with what has been a shocking, stunning, positive earnings surprise over the last quarter.
Micron just hammers it home. Everyone was saying they can't get better than this, and guess what? They did. And that 80, what
mega
was it?
margins, 85%.
Margins, absolutely stunning.
Coming up tomorrow, another bull, John Stolfus of Oppenheimer, alongside Wei Li of BlackRock, Bob Michael of JPMorgan, Kevin Gordon of Charles Schwab, and a whole lot more from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.